Assalamu alaikum wa rahmatullahi wa barakatuh.
Wa alaikum assalam wa rahmatullahi wa barakatuh.
Am I audible?
Assalamu alaikum wa rahmatullahi wa barakatuh. Islamic finance is currently the growth sector of the global financial markets. It has been growing in the range of 15 and 20% over the last 5 years and is expected to grow at around 10 to 15% over the next 3-year period, as quoted by John Wegwelin, Zenith Bank, UK. Justice Krishna Iyer from India has quoted that Islamic finance has proven successful in poverty alleviation and promoting sustainable growth in many countries, including the US, and it's very relevant in our country where 20 million people are starving. I welcome you all to the webinar, How to Make Investments the Halal Way. In the webinar, we are going to learn about the share market and the halal way of identifying the shares and halal trading. It's my pleasure to introduce to you Brother Jubran Siddique, who is a Shariah-compliant investment banker based in Chennai. With dedication, determination, and discipline, Brother Jubran Siddique has developed a strong, cohesive vision to lead our current and future investment strategy for a better tomorrow. Focused with the idea of being able to revolutionize the working of the investment and finance industry by integrating the Sharia-compliant or ethical way of investment with the current investment developments in the world. He has successfully managed to diversify his portfolio in 9 different industries in the past 5 years. At present, he is the CEO of Zaria Investment Company, Managing Director of JJF Square Private Limited, Trustee of Aspire College of Excellence and Humanity Cross. Remember, sharing knowledge is gaining knowledge. We would really appreciate you typing your questions on the topics covered in the webinar in the comment box or the chat box. Selected questions will be answered at the end of every 45 to 50 minutes. Each question and answer session will last for 15 minutes each. Brother Jubran on the topic, how to invest the halal way.
Assalamu alaikum wa rahmatullahi wa barakatuh. Alhamdulillah wa salatu wa salam ala rasulillah wa ala alihi wa sahbihi ajma'in. Amma ba'd. Rabbi shrah li sadri wa yassir li amri wa hlul uqdatan min lisani yafqahu qawli. I would like to thank Allah Azza wa Jal to give me this opportunity to talk on this topic, how to invest in stocks the halal way. The intention of this course has always been to be able to create a sort of a source of revenue, or to be able to help people currently who are struggling and suffering in regards with how to create an alternative source of revenue during this time, especially after COVID, because a lot of people have been coming to me and approaching me and telling me that they have been finding it very difficult to have a sustainable source of revenue. Not to say that investing in stocks is a sustainable source of revenue, but at least the intention of this has been to create a sense of awareness, to create a sense of clarity, and also to be able to help people to be able to initiate an alternative source of revenue wherever they are in any part of the world. I would also like to thank all the attendees to give me this opportunity to speak to you on the topic of how to invest in stocks the halal way. You have invested your time as well as you've invested your money, and I hope that Allah Azza wa Jal makes it beneficial for all of us. Before starting this session, probably I would like to clarify on a few points. I understand that with the participants, there are few participants who have a fair bit of understanding on what investment in stock market is all about. There are few participants who have no basic understanding about what investment in stock market is all about. I have been interacting with a lot of participants in the last couple of days, and I've realized there are a lot of people who have no basic understanding of the stock market. So I hope that you bear with me, because I have made sure that we make this presentation in such a way that the person who has no basic understanding about the stock market will be able to learn and integrate and at least create a self-sustaining concept of investing in the stock market eventually, inshallah. As we all understand that the finance is a boring topic, and finance has its own sets of ups and downs. So I will try to make sure that I make this PPT as interesting and as cheerful as possible. Whenever there is any doubts, you are free to ask me in the chat box below. I will try my best to answer the questions. It's a 2-hour session in terms of theory and 1 hour question answers. So what I will try to do is I'll try to split the question answers between the session, not to keep it towards the end, because it will be easier for us to be interactive also. Because during the whole session, if I'm constantly talking and you're constantly listening, probably it could become a little boring as well. I will also encourage you to find your investing partner, because in my experience of investing in the stock market, what has happened is when you do it alone, it is easy for your emotions to take better of you. I would suggest that you get a partner who you can work with, who you can invest with, and who you can understand and analyze the stocks with, because mashwara has its own barakah. And this is exactly why we are bringing to you with one of our concepts called Halal Investment Network, where all the people who have been associated with this course and all the people who are going to be associated with this course in the future, we will be integrating you all to an halal investment network. And we will also be converting all our WhatsApp groups to be a networking group where we can help each other to become better individuals, to become better people in the respective businesses which we are doing. So inshallah, with the networking which is coming forth after these sessions, we look forward to see all of you grow together, inshallah. So let's start the session today. The session flow, basically, we have 2 days. So I'll be looking forward to segment the session in such a way, because we do not know how. We have a fair bit of understanding about what we'll be doing today. We'll be discussing about what the share market is all about, what are the indexes, different concepts in share markets, what is the halal way of analyzing a stock, and what are the different ways to understand and read a graph. Inshallah, we will see how elaborately we can focus, because generally a stock market training goes on a face-to-face basis in terms of personal interaction. Since this is a Zoom session, we hope that we give our best to make sure that you are able to understand, and we'll try to go as slow as possible. And if there are any doubts, please feel free to type it in the box below. Now, as I always say, it is important, people who have attended my session before will be able to understand this, that I always believe that if you're listening to a speaker, or if you're in a particular session, you have to be able to understand the background of a speaker, and you have to be able to understand from where he's coming from, with what sort of an experience, so that you'll be able to connect with him better, and you'll be able to learn much more and be able to make more benefit out of it. So let's to give you a small brief about myself. I was born and brought up in the Middle East. I was there for approximately around 13 years. I grew up there, then I came back to India for my further education. How I got my passion towards investment was during my childhood, when my father particularly was working in a company called Mustashfatul Mamlaka for Prince Walid bin Talal. And that's where I used to go with him to his office, and I used to see a huge wall wherein there were a lot of companies which he had invested upon, and there were a lot of companies which he had particularly added to his portfolio. So that's where I realized that, this is quite fascinating and this is quite passionate. So I constantly, just started looking up to who he was. And then I realized that Prince Walid bin Talal was the richest Arab in Saudi Arabia who was running the company. And that's what gave me a small fascinating trigger. I was quite young, so probably that took the most out of my emotions. And then I started doing my fair bit of study and research in terms of stock market and investments, because he was a stock market investor. So I started studying different types of investors in stock market, different successful strategists. What are the studies to be done? So probably for a long time now, almost for 14 years, I have been doing my study. But I came into the stock market aggressively by the age of, say, around 17 or 18, when I have started doing my different forms of exams for NSE and for BAC and for SEBI, and different exams which I had written for my personal understanding in terms of investing into the stock market. And eventually I did put a little bit of money. I did make quite a bit of money, and then I did lose a lot of money. And then during this whole process, I would also like to help you make you understand that the whole idea of this session is not to hypothetically hype a concept saying that you will be making a lot of money, you'll be able to earn a significant amount of return. No, the whole idea of this concept is to share with you as much as possible with the experiences which I have gained, with the failures which I have gained, because the best way to teach you, the best way to able to explain to you is with the failures, with the negatives which we have learned in the last couple of years. So I would request all of you to consider this as an opportunity to gain a different concept or different understanding on how to create an alternative source of revenue, because investing in stocks has its own pros, but it also has its own cons. So this is to give you a brief about myself. I have come from a background wherein we had invested, we had lost, and we had seen a lot of ups and downs in the stock market. And this is exactly what I will be looking forward to share with you today, with all the failures and all the successes which I have received. So as we all understand that investing into ourselves is the most important investment you can make. So I would like to congratulate all of you to invest your time as well as to invest your effort in learning something. May Allah Azza wa Jal make it beneficial for all of us. I hope that you're making the best use of the session, and I hope that at the end of the session you're able to get what you want. So as we all understand that there is a basic there's a very important hadith from the Prophet ﷺ where he said that on the day of judgment will be questioned on 5 things. That is how you live your life on this earth, how you utilize your youth, how you earned your wealth, how you spent your wealth, and how what did you do with the knowledge you had. So here in this session, in this workshop, we'll be focusing on point 3, point 4, and point 5, where we will be discussing about how you can earn your money, how you can spend your money, and what you can do with the knowledge that you earn in this workshop, inshallah ta'ala. What, according to you, is stock market? Basically, it would be more beneficial if few people can interact in the chat box. You can discuss with me. You can tell me what, according to you, is investing in stock market. What, according to you, is stock market all about? Because I have seen a lot of people who have been coming to me saying, stock market is a place where you can make a lot of money. Stock market is a place where you can become rich very fast. Stock market is a place where you can gamble. Stock market is a place which is completely haram. So many misconceptions about stock market, so much of lack of clarity what stock market is all about. Stock market is a very basic fundamental concept where it is a collection of markets and exchanges where you do buying and selling and issuance of new shares. Now a stock market is a collection point. It's like you're going to a market where in those market you have different stores, and these different stores are selling to you, and this stock market is basically an aggregate of all these companies which are under this. So a stock market is basically a collection of markets and exchanges where you can do buying and selling of shares and also issuing of new shares. Now the stock market is generally classified into 2 halves. That is, one is the primary market, the other is the secondary market. Now the primary market is not something which is predominantly used by a lot of people because it is more reserved and more conserved to initial shareholders of the company. So the primary market is predominantly used for issuing a particular company into an IPO model, that is initial public offering. So if a company is going from say a startup, then it's growing and then it's going first time into the stock market, they use the primary market to launch the company, and from there onwards it's the secondary market which takes over, and that's exactly what we're going to focus on. That is the secondary market in terms of where you can invest in the equities and how you can invest in the equities. So that's exactly what the secondary market is all about. What are the different indexes, or what are the different stock market platforms in India? It is NSE and it is BSE. National Stock Exchange, Bombay Stock Exchange, both of them are more or less the same. They are mirror images, but Bombay Stock Exchange was much older. It came initially long time back, almost approximately around 60-70 years back, and NSE had launched recently. Both of these markets are respectively guided and mentored by Security Exchange Board of India, which basically makes sure that these markets are complying with the necessary compliances, and they're also going with the right format in terms of rules and regulations, and they constantly watch the buying and selling so that they can see no fraudulent activities happen. What are share indices? What are the different types of share indices in India, and what is an indice? or what is an index? Plural is indices. So index is, as we discussed, stock market is it's a market wherein you have multiple buying and selling happen. This market is called an index. So in India, you have two types of indexes. One is Sensex and one is Nifty. Sensex stands for sensitive index and Nifty stands for national 50. Now, Sensex is the predominant factor which controls the Nifty. Now, Sensex has no companies under it. Sensex has only indexes under it. So what Sensex does, it is an aggregate of multiple indexes. You can talk about pharma index, you can talk about banking index, you can talk about IT index, you can talk about automobile index. So the aggregate of these multiple indexes is called Sensex. Now, what is Nifty? Nifty is one particular index which has 50 companies which are supposed to be the best companies performing in India. They are called blue chip companies. Now, what are blue chip companies? Blue chip companies are those companies which have been established for more than a couple of decades and who have been showing consistent growth in the company for a long period of time, and they have been giving consistent returns to the investors as dividends over a significant period of time. Now, Nifty 50 stocks keep fluctuating, keep changing based on the performances. So the idea of creating a Nifty index is to create the top 50 performing companies in India. So if there is a stock which is not performing, and if there is a company which is not been giving significant returns, that company will be taken out of the 50 index, and there'll be another company which will be put inside the index to make sure that the index has the best companies in the current market standards. What is a share? Now, the whole fundamental of the stock market or the share market is all about understanding what is a share. Share is a unit of ownership of a company. Now, this is something which a lot of people understand in a different format. This is something a lot of people think is a very common concept where, you know, you can buy and sell shares in a company, and you can do multiple transactions with the units. But people fail to understand that when you invest in a particular company, when you buy shares, it is all about being an owner of the company. Now, the famous Warren Buffett says, whenever you invest into a company, always consider that you're buying the whole company. So buying even one unit of share makes you a part owner of the company. You have to understand that when you're becoming a part owner of the company, you have to consider the complete underlying factors of different things which are involved with the company. Now, generally, a share is a percentage of ownership in a company or a financial asset. A share could be necessarily in the stock market, or it could be off the stock market as well. Investors who hold shares of a company are known as shareholders, which we all understand. Now, shareholders can be of two types. One is in the public market and one is in the offline market. Owning a stock generally means buying a percentage of ownership in the company, but a lot of people have misconceptions about the stock market. A lot of people have misconceptions about what share ownership is. In the West, there are a lot of people who, once they buy shares in the company and when they get the share certificate, they try to go to the company and try to claim benefits from the company, which generally is not the right attitude and right personality, because investing in the share market is trying to bring in the necessary revenue for the company which is required as and when the company is issuing shares. What are the different types of shares? Now, there are two types of shares. One is equity shares and one is preferential shares. Now, preferential shares are those shares which are given to the in-house existing shareholders, wherein these people are getting preferences over the other equity partners in the stock market. Now, preferential shareholders are generally given dividend priority over the stock marketing people, because these are the people who have been supporting the company from the back. These are the people who have been being the founding factor of the company, so that they can become better individuals, or the company can become more successful in terms of what they have been targeting to achieve. Now, what is the second segment of shares? Equity shares. That is exactly what we're going to talk about today, in terms of how you can invest in those shares, and how you can be a part of their shares, and how you can make your revenue out of those shares, inshallah ta'ala. There are different types of investments. Now, in the whole of the world economy, there have been so many different products which have been launched by a lot of other people, in terms of what a lot of other institutions, in terms of collecting money so that they can give different sort of returns. Now, few of them which probably all of you understand is fixed deposits, bonds, gold, stocks, mutual funds, public provident fund, exchange traded funds, national pension scheme, and real estate. Amongst these products, there are only a few products which are Sharia compliant. Now, which come under a Sharia compliant category is stocks, is real estate, and is exchange traded funds in a blind perspective in terms of following the categories. When it comes to gold and it comes to bonds, there are only a few products in the world which make it Sharia compliant. Like, for example, investing into gold in online market is not considered Sharia compliant. But investing into gold in an offline market, where when you're buying the product, you get the composition of the commodity, is considered Sharia compliant. Bonds, again, in the Indian market, currently, we do not have any Sharia compliant bond. But in the global market, in UAE, in Malaysia, in a lot of Islamic countries, you have Islamic bonds called sukuk, which can help you generate revenue in a safer format. Now, what are the fixed deposit? Now, fixed deposit is a basic term which a lot of people use fixed deposit is a basic term which a lot of people use to save their money, wherein they deposit a particular amount of money for a long period of time, and they get a particular amount of interest return out of it just to keep their money safe. What some Muslims do is they give off the interest away and they keep the money in the fixed deposit so that they can at least not spend the money unwantedly. That again is not considered Sharia compliant, because it is important to make sure that your money is allotted or kept in the right tools, because even a small drop of something which is haram which comes into your portfolio can affect your whole portfolio. Mutual funds, on the other hand, is a pool of investors where they put multiple corpus of funds. Say, for example, there are 100 people pool in approximately around 1 crore rupees each, so it becomes a 100 crore fund. And this 100 crore fund, what it does is it goes to companies when the companies are into a very doldrum situation or in a risky situation. They go to these companies and they tell them, okay, probably we'll invest in your company and you can give us a major share, or at least a better share than what you would give normally, and we'll invest in your company, will increase your share price, and will constantly support you whenever you need the liquidity or the funding which you need in the market for your share value to be on high. So mutual funds generally are something which I am always a little doubtful about, because there are a few Sharia compliant mutual funds in India. Tata Ethical Fund, then you have Taurus Mutual Fund, then you have also one or two other funds which have come, which have been said that they are Sharia compliant. But yet again, it is important that you see that a mutual fund is more dependent on a collection of investments, and it gives you an aggregate return which probably does not have the necessary feel for you in terms of understanding what the market is all about. Because the whole idea of investment is, you know where you're investing, you know how you're investing, and you know exactly what return you're expecting out of the investment you're making. And gold, yet again, I've discussed about it. Exchange traded funds. Now, exchange traded funds are something which is considered Sharia compliant when it comes with gold and silver. Now, this is something which we have been working on the Indian market for quite some time, where by exchange traded funds means when you're giving money, you get the possession of the commodity, and when you're selling the commodity, you're getting the possession of the money. So it's give and take policy. And this is something which is not very aggressively used in the Indian market. It is still very nascent. It is still very new. And this could be considered Sharia compliant with the commodities. And without doubt, you understand real estate, it is absolutely Sharia compliant when it comes to buying and selling of houses, but provided you're not going into any sort of loan formats or any interest based vehicles. Public Provident Fund and National Pension Schemes are basically government-based vehicles where it helps you get a portion of their salaries in terms of provident funds, and it use that same thing to give you back at the end of your tenure of your working. Or National Pension Scheme, where after you retire, the government gives you a portion of your money back to you regularly. Now let's come to the foundation of the course. What is Sharia, and what is the whole idea of doing halal investments? Sharia in literal terms means the clear, well-trodden path to water. So it's a very clear path towards the flow or towards the purity of water. And Sharia law acts as a code for the living of all Muslims. This is a universal code which generally every Muslim should abide by in terms of how they live, how they stay, how they eat, how they earn money, and how they grow. So following Sharia laws universally have been proven to be the most strongest way to grow in terms of your personality, in terms of your portfolio, in terms of your investments, in terms of your business, and everything. And without doubt, this is exactly what we're going to focus on today. First thing to go into halal investment is the niyyah, is the intention all of us in this world, I've been getting a lot of people who've been discussing with me saying, in today's world, it's very difficult to do everything Sharia compliant. They have their own pros, they have their own cons. The situation is such a way that Muslims cannot do things in a Sharia compliant manner. There are a lot of people from different parts of the world who are against us. No, that's not what I would particularly believe, because I believe there is always an opportunity. I believe there is always a way to make your revenue in a halal manner. It's just the right intention you need to have. Without doubt, you'll be tested significantly. You'll be tested in major portions of your life. You will have an opportunity right there. Like, for example, when I started my career, I started with MCX as an MCX certified trader. So when a person coming from a commodity background, when I invest in the online market in the commodities, I know that I can see a significant return. I know I can see a lot of revenue, because commodity market is such a place where if you put 2,000 rupees or 5,000 rupees, you can make 10, 15,000 rupees in 1 hour or half an hour. It's so fluctuative, it's so aggressive. I started my business, started my career with that. But eventually, when I realized it's not Sharia compliant, probably after a year or so, or 1.5 years, when I realized it is not Sharia compliant, to let go of it was a very big challenging task, because I knew I could have made significant returns. I knew I could have been, in a very good part, and I had excellent people to mentor me and guide me in regards to the market, 40 years of experience, 50 years of experience. But that one intention, that one decision to follow up on the intention which I made, that we have to do things the right way and we are answerable to Allah subhanahu wa ta'ala, helped me in such a way that during the initial process, it seemed tough. It seemed very difficult. I did not know probably what could be the outcome. But today, by the grace of Almighty, that decision is something which is the founding pillar of what I have established in terms of my business and what I'm doing today in my day-to-day lives. So it's very important that we make the right intention, because inshallah, if we make the right intention, Allah will give us the prosperity, the barakah, and make it easy for us to achieve what we intend to do. Now, what are the different ways of screening a stock? A stock can be screened in two ways in terms of Sharia compliance. The first way to screen a stock is a sector-based screening. That is, when you are studying a stock, you need to be able to understand what sector it's from, and you should be able to understand what are the accounting background or accounting fundamentals of a particular stock. Now, when it comes to sector-based screening, it is the industry which the stock is involved with. So there are a lot of industries in this in the Sharia compliant category which are not considered halal, which are not considered Sharia compliant. Now, it's up to us how we particularly focus on these industries and these sectors, and to see which sectors we're going to focus in and which sectors we're not going to focus in. The second category is accounting-based screening. In accounting-based screening, it is where we will be trying to teach you how you can study a company in the fundamentals, in the basics, and see how you can analyze a company based on its cash flow or its accounting, whether it's Sharia compliant or not. It is a technical thing. Probably many people will not be aware about how to study a balance sheet or how to go through it. We will give you a brief outline about how to do it. In terms of sector-based screening, what are the few things which you have to consider? Now, today, whatever I'm going to talk to you about in terms of halal investing, it's going to merely be a concept which has been recognized and certified by different Islamic institutions all over the world. One is IOFI, auditing and accounting and auditing of organizations for Islamic financial institutions. And the second is Islamic Financial Service Board. These are two biggest organizations which certify multiple Islamic banks and Islamic organizations all over the world. IOFI is in Bahrain and IFSB is in Malaysia. Now, here we are going to just focus on the basics of what are going to be a non-Sharia compliant industry, because I see a lot of people have been messaging me and telling me it is something which is very tricky, which is very technical. We are not going to go into a lot of technical things. We are going to go into the basic foundations and fundamentals of what Sharia compliance is all about. Now, in terms of Sharia compliance, sector-based screening, most importantly, there should be an absence of riba, that is interest, in any investment. So the companies which are investing in the stock market or other than the stock market still should be away from riba, that is usury or interest. The second is unethical concerns in the investment mix. Now, what do you mean by unethical concerns in the investment mix? When you're investing in a particular company, or when you're mixing your investment with a company which is looking like it's Sharia compliant, but they have unethical concerns, they have unethical ways of conducting themselves, they have unethical principles, rules, and regulations, then that again is considered non-Sharia compliant, because on the outside it will be looking very clear, on the outside it will be looking Sharia compliant, but when it comes to the foundation, that is the niyyah, when the niyyah is not right, that doesn't come under a Sharia compliant category. Now, what are the benchmark industries which are not considered Sharia compliant by a lot of scholars unanimously all over the world? That is excessive debt, that is banking companies where they give you debt and they charge usury for your outstanding amount, or companies which are significantly exposed to debt. Now, according to Sharia compliant norms and categories, the companies which are considered between 5 to 10% debt ratio are considered Sharia compliant. I personally believe that there are a lot of companies which are debt free, and the best way to invest in a company is when the company has very low debt or there is no debt at all. Now, but the thing is, the world market, the world economy is made in such a way that unless and until you do not expose some liability or some debt, you do not get concessions on taxes, you do not get benefits from the governments. So, a lot of companies in the Western countries are companies which have to take debt to grow, or which is it's compulsory by the government to take debt so that you grow your company. Now, in such cases, the scholars have unanimously agreed that the company which comes between 5 to 10% of debt category is considered Sharia compliant. But yet again, in India, that is not a very strict rule. You have your independence. You can invest in companies which are debt free, and there are a lot of companies in the stock market which are debt free. So I would encourage and I will suggest people to not invest in companies which have a debt exposure unless and until you have a sure shot concept in terms of understanding, okay, this company is surely probably going to grow in the next 1 month or 2 months. The next industry is tobacco. Tobacco industry, smoking is considered non-Sharia compliant. As you probably, just to give you an example, ITC. ITC is one of the oldest companies in India, which is also one of the biggest manufacturers of tobacco-related products in India. So yet again, it is not considered Sharia compliant. Alcohol is not Sharia compliant. Firearms, that is companies dealing with defense mechanisms or defense machineries, is not considered Sharia compliant. This is something which a few people ask, why is defense not considered Sharia compliant? It could be used to safeguard the Muslims. But yet again, if I go into details of all the companies which do the manufacturing of technology in terms of firearms, in terms of other things, we have a fair bit of idea about who are the people who significantly produce these firearms and who are the people who sell these firearms to which countries and for what purposes. So firearms is yet again considered non-Sharia compliant. The next would be gambling. Any companies which are into betting or gambling or any sort of blind revenue generation model is yet again considered non-Sharia compliant. Adult industry, entertainment, pornographic, or any other sort of obscene industry is not considered Sharia compliant. Impure food stocks, like for example, we have a few companies in India which are into the food industry, which is Sharia compliant. But in that food industry, they also supply products like pork. They also supply products like other items which are generally not considered Sharia compliant. So this is something which you have to be very careful about. Like in India, you have Jubilant Foods, which is the owner of Domino's Pizza chain. It is a stock which is very strong. It's a stock which has strong fundamentals, but yet again, it is not considered Sharia compliant because it also deals with its revenue which comes from pork and other industries. Now, the next topic is usurious institutions, that is NBFCs and banking industries, which generally lend money on financial or interest-based models. This is yet again not considered Sharia compliant. Insurance companies, which depend upon collection of funds, is not considered Sharia compliant because insurance companies are under a big dilemma when it comes to scholarly opinion, and it is told that it is not Sharia compliant unanimously by a lot of scholars. Now, insurance is something which a lot of people have made their fortune in terms of successful investors. If you see, Warren Buffett made his predominant revenue, made his predominant what do you say fortune with his investment into insurance companies. Now, that is something which is not Sharia compliant yet again. Or probably if you say impure food stock, there's also something called five-star hotels, which generally have their own bars, which generally give people alcohol drinks, which again is not Sharia compliant. And last but not the least, this is something which is added newly by the scholars recently: gold and silver on deferred cash basis, where people trade in gold and silver, but they do it on a deferred cash basis in terms of credit, rotating the money with contractual basis and trying to create a demand and supply. This yet again is not considered Sharia compliant by a lot of scholars. Now, any business which derives 5 or more percentage of its revenue from these companies respectively are not considered Sharia compliant also. Now, what I mean by 5 or more percentage from this revenue, for example, there is a IT company which derives more than 5% or 10% of its revenues from banking industry, or for adult or pornographic industry, or from any other industry which is not considered Sharia compliant, is yet again considered non-Sharia compliant. Now, there are a few scholars who yet again say that if the ratio is between 5 to 10%, probably you can take off that 5%. I mean, if the ratio is within 5%, you can take off that 5% and give it to charity for poor. But I would suggest, why to go into something which has its own doubts? So what generally a few scholars in different parts of Middle East suggest is that if you are investing into a company which derives 5% of its revenue, say for example Infosys, I'm just saying for example, it is not a non-Sharia company, it is Sharia compliant. Now Infosys, say for example, derives majority of its revenue from a banking industry, say example it's deriving around 20 or 30%, it is completely non-Sharia compliant. No, but if Infosys is only getting 5% of its revenue from, or 10% of its revenue from banking industries, what scholars are saying, take off that 5 to 10% and give it in terms of charity, and then from what profits you have made, and then probably you can use the rest. But yet again, when it comes to the Sharia compliant norms, having a gray area is something which always gives room to fitna, always gives room to lack of clarity. So I would suggest we go with companies which are completely Sharia compliant. Now, a lot of people would say that so many rules, so many regulations, so many restrictions. How can you actually make money in stock market? You cannot invest in future and options. You cannot invest in derivative contracts. You cannot do anything else. You can invest only in cash market, and in cash market also you have so many restrictions. What is this? This is not the way how you can make money. But trust me, there are a lot of ways you can do this, and there are a lot of comfortable ways where you can actually make revenue in terms of these rules, but in terms of following these rules and making sure that you're into a Sharia compliant norm. That is exactly why I said the niyyah, the intention, comes into play. It is very important to have the right niyyah, and inshallah Allah will make it easy for you to get the revenues from the right sources and right places. There are a couple of Sharia indexes in different parts of the world. There are Sharia indexes in the West. There are Sharia indexes in India. So you have S&P BAC 500 Sharia index, which has around 500 companies which are Sharia compliant. Then you have S&P Sharia screening partners, where they help you in terms of screening the companies whether they're Sharia compliant or not. You also have Sharia 50 index, you have Sharia 25 index, and you have Sharia 500 indexes, which is basically watched by one of this organization called TASIS, which is in Bombay, which is headed by Mr. Khattate Saab. And they do the screening processes for these companies into the stock market to consider whether they are Sharia compliant or not. So there are a few indexes in the Sharia compliant industry. Probably you can see 500 companies and another 25, another 50. These companies are Sharia compliant, but yet again, just because they are into a Sharia compliant index, or just because they are into a Sharia compliant industry, it doesn't necessarily mean you can blindly invest in these companies. So during this whole process, during this whole course, I would highly encourage all of you to understand that investing into stock market requires understanding, requires patience, requires emotional control, and requires the understanding that investing in stock market is not always about earning money, because it's more about losing money than earning money. It's more about waiting for the right opportunity than always searching for the opportunity. So let's understand this personality, because during this whole course, it is not the foundation, or it is not the basics which I'm going to talk to you about is going to make a difference. It is the attitude, it is the personality, it's the change in your thinking which will come out of this, which inshallah will benefit you to help you become a better investor. So please understand, whatever fundamentals, whatever foundations I'm teaching you, it is unless and until you do not have the right mindset, unless and until you do not have the right personality, right thinking, or right approach towards investments, you will not be able to do what is relevant. Totally, there are around 40% stocks in India which are Sharia compliant, and 60% of stocks which are non-Sharia compliant. So when it comes to 40% of stocks, it's a huge market where you can actually study different companies in the in the whole of the stock market present in the Indian market, where you can study these companies and you can find out which are Sharia compliant, which are not. So there is enough opportunity and enough room to make a lot of revenue in terms of different companies in the markets. to start off, before I start off with the session, it's very important that we understand the foundations on how we use our wealth, and how we need to have tawakkul in Allah subhanahu wa ta'ala, because there are a lot of times where things could go wrong. There are a lot of times where in stock markets things could go down south. So having taqwa in Allah subhanahu wa ta'ala is very important, and having the intention to use your wealth in the right purpose is very important. So inshallah, with this, Allah will make it easy for all of us to grow in a very prosperous and halal manner. What is an investment? Now, since we're talking about investments, and since we're talking about how to make revenue, we need to understand what investment is all about. The famous Tony Robbins, he is a person who is known to mentor billionaires all over the world. He himself has 6 businesses which is worth more than $5.5 billion. Now, Tony Robbins is basically a mentor, is also a person who teaches people in terms of how to invest in stock markets and different markets all over the world. According to him, investment is an asset or an item that is purchased with the hope that it will generate income or appreciate in the future. Now, there are 2 ways to understand an investment. A lot of people generally consider an investment to be something where people will put money and get an immediate return, or get a return in a short term. But the actual definition of investment is putting your amount for a significant period of time, where it appreciates in terms of dividends, also it appreciates in terms of value. So these are the things which you have to understand. Now, most of the time what happens is, if you have to understand the right concept of investment, it is like you're purchasing a land. When you're purchasing a land, you're investing on construction of the building, and after you construct the building, you're giving it on rent. So you're also getting your revenues in terms of rental value, and you're also getting your revenues in terms of appreciation of the land. So it is more important that you understand that how you have to invest your money, because you don't have to necessarily invest only on the rental income. That is, a lot of people invest with the concept that they have to get dividends. A lot of people invest with the concept that they have to get returns, and a lot of people invest with the concept where they have to get a significant portion of revenue on an immediate basis. But I would suggest the best way of returns is where you can actually invest for a longer period of time, where you wait for the value of time to kick in and to develop the actual format of return, which is important. Like, for example, if you are investing into companies, you can invest into companies with a shareholding concept on actual format, and you can get shares, and you can wait for the shares to appreciate if you're confident that the company will grow. And simultaneously, if the company is sharing dividends from you at the end of the year, probably that is also an added advantage. Now, we will take a 5-minute break or 10-minute break before we proceed further. And in this time, I can spare like around 10 to 15 minutes for a brief question answer session. If you have something which you want me to specifically talk about, please mention it in the chat box. Around 5 to 10 minutes, we'll just have a discussion, and we can discuss about what topics you want to talk about and what are the doubts you have as of now, what I've discussed. So we'll make it more 45-50 minutes talking and 10-15 minutes discussion, so that way it will be at least more refreshing for all of us. So I see we have 1 second. Okay, so there are a few people who have raised their hands. So Nauzia Fatima has asked a question. Could you suggest a measure to check if a company is Sharia compliant in terms of debt? Okay. Now, in terms of debt, scholars have multiple opinions. Like, for example, IFSB and IOFI have their own standards, where they have suggested that up to 25% debt is allowed in a company in international norms. But yet again, I feel that it is important that you can search for companies which are more into the debt-free industries, because you have a lot of tools and softwares which can help you understand whether the company is Sharia compliant or not. Like, you have something called screener.com, screener.in. All these tools I will give you during the course. There's something called screener.in, where you can study a company's fundamentals, and you can figure out how much debt they're exposed to, what industries they're getting their revenues from, and whether they come under Sharia compliance category or not. So when it comes to debt equity ratio, internationally, scholars have taken it up to 25%, but we sincerely suggest and request that people do not go with the 25% model, because once you go to 25% model, it goes very elaborate and it goes into a larger, it goes very elaborate, and a lot of people end up getting misguided. So let's focus on non debt-free companies which are not exposed to debts. That way, it will help you have a stronger fundamental of a company, because when a market falls, or once there is panic or there's some collapse in the market, the companies who are significantly exposed to debt are the people who will fall first, are the companies which will fall first. A company which is debt free, a company which has strong fundamentals, is a company will sustain in any market, because when a company has no debts, it means it has surplus cash, it means it has surplus revenue, and it means it has surplus amount of money to give you back whenever it's required. The next question is by Muhammad Farooq Sahab. He asks that whether intraday is halal or not. I personally, in my opinion, with different scholars, I am under an not under a thinking, but it is unanimously agreed that intraday is not Sharia compliant, because intraday is something where you're doing buying and selling on a daily basis, based on whatever momentum you see of the stock. You're not investing in a stock, understanding a stock. You're not investing in a stock with a particular intention that this company will grow to this value, or understanding its management, or understanding its future pipeline. Intraday is all about making your money today. And second most important factor is about making a company which is Sharia compliant, is whether do you get the delivery of the product in your hand. But when you do intraday, you do not get the delivery of your product. You get the stock in terms of your portfolio, but that doesn't come to you as delivery. Delivery comes only after T+1 or T+2 days. That is called the settlement duration. So when there is no delivery, it is not halal for you to invest in a particular stock without getting the possession of it. So you're buying, selling, because when you're doing intraday, say for example, you're owning a stock today, and you probably see the market is falling, you're selling the stock at 100 rupees. Suddenly you see the stock has fallen down to 85 rupees, you're buying the stock again. So when it comes to intraday, you can see that in that 10 to 15 rupees, if you buy the stock at the end of the day, that 15 rupees will actually be converted into your margin. The stock will still remain in your portfolio. Now, this is a tricky thing which I'm telling you. I will repeat it again. I will go slow. Now, when you have a delivery of a stock, now a lot of people, what they understand that, in cash market, it is only when you are buying a stock, where only then it is considered Sharia compliant. Yes, when you buy and keep the stock, it is considered Sharia compliant. But after you keeping the stock, if the stock is falling, you decide to sell at, say, value X or 100 rupees. The stock you have sold at 100 rupees, and after that the stock has fallen significantly at 85 rupees. Okay, now you feel that the stock will only grow. So in the same day when you purchase the stock at 85 rupees, the software or the index will not consider that as a sale and purchase. That will be considered as a temporary deficit to get that 15 rupees as your revenue. If you understand it clearly, that 15 rupees will be considered as your revenue. So at the end of the day, you have sold and you have bought. You have sold and you have bought. That even if you're selling a product which you do not have, will still give you a revenue. So that's something why investing into intraday is yet not considered halal and Sharia compliant. Officially, say occasionally, once in a very rare moment, when probably you decided to sell today and suddenly you felt no, there's news coming up, I need to buy a stock. You can buy the stock on the same day probably, but not as a habit. I would never suggest or encourage people to invest in the stock market on an intraday basis, because the faster you make your money, the faster you lose your money also. And the faster the money leaves you and goes also, because it's more easier to make. The faster a person is able to generate the revenue, the faster he ends up spending it as well. This is what I've seen the last couple of years. The next question which I've got is from Nauzia Fatima. Yet again, please suggest 5 companies in each large cap, mid cap, and small cap funds. Now, during this course, there's something which I have specifically made my intention that I will not suggest or I will not share recommendations, because the whole idea of this whole course is that you get the inquisitiveness, or you get the basic knowledge on how to consider a company to be a right investment. Because if I am giving you a recommendation, my whole foundation of this course will be waste. Because if I'm going to give you a recommendation, why should I take a course at all? Because if you are coming here for this session hoping that you're going to learn something, and you hope without doubt, if you're learning something, if you're coming for this session, it's because you have a certain amount of trust that I'll give you right direction or right understanding about the market. But in that particular point of time, if I'm giving you a recommendation, you will obviously follow that recommendation, and it does not serve the purpose of understanding the industry. So we will teach you how to understand a stock, how to understand an industry, so that you can find your respective companies in the large cap, mid cap, and small cap industries. Now, what we could do is, to add value, we will be giving you this 3-month incubation wherein you can constantly discuss and update yourself with us, where we'll be guiding you and mentoring you, saying probably this is a company which could have these negatives, this company can have these positives. So we want to encourage you to take the lead, and we'll be standing behind to constantly give you our inputs. But I would not suggest to give recommendations to any of the people here or whoever come to me, because that is not the right way to make a person a good investor. Brother Muhammad Ismail has asked, can I elaborate the concept of index? Now, index is the fundamental of stock market. Indexes are of different types: Sensex, Nifty. Then you have pharma index, you have IT index, you have auto index, automobile index. Then you have banking index. You have so many other indexes in this in Indian stock exchange. Now, index is something which is like a supermarket. So you can consider it to be a supermarket, and you go inside a supermarket, and that in that supermarket you have one separate floor only for pharmaceutical products, one separate floor only for IT products, one separate floor only for banking products. So indexes is something like this. So you're entering a particular market. There is, in one particular division is only pharma, one particular division is only IT, one particular division is only banking. You can choose which store to enter and which store to buy from. Now, what a few people do is, they do not buy from the store. They say, okay, this whole floor is good, this whole index is good, let me invest in the index directly. That is, they invest into Nifty or they invest into Sensex to get the contracts, where they're investing on a concept that probably an aggregate of companies will do well. But at the end of it, when you're buying that index or buying that say particular platform, you're not having an underlying asset, you're not having an underlying product. It is only affecting the price fluctuation, but at the end of the day, you're not getting a delivery of a company. Say, for example, uh, today I'm buying IT company or some, say, Infosys. I at least get a delivery of stocks. 20 years down the line, 30 years down the line, my children or my subsequent family members can use that share to encash it and to get better returns. But if I take a contract of Sensex or Nifty, I have to at the end of a month give it off, or at any point of time I'm not going to get any delivery, because it's just an aggregate of companies which is fluctuatingly showing different values based on what inflow and outflow is happening. So that is something which I yet again suggest people not to do, because that is very fluctuative and very risky. It is more like bidding on something. Probably we have another 5 to 10 minutes to take some questions. 5 minutes just, I think. Okay. Is commodity trading halal? Please share once more the name of the depth check. Okay, screener.in, I think a few people have mentioned in the chat box. Is commodity trading halal? Commodity trading in the online market is not halal. Commodity trading in the offline market is halal. With offline, what do I mean? ETFs, gold ETFs, silver ETFs is halal. Commodity ETFs is halal. In different countries, you have ETFs. India does not have an ETF. But you can, there are different countries which have ETF models. ETF concepts are halal, because at the founding factor of investing into an online market or commodity market is, you should not be able to sell something which you do not have. So if you are able to short something in the online market, it means you do not have the possession of the product. It means you are selling something which you do not have, and it is again against the principles of Islam. The principles of Sharia means you have to sell only what you have. And when you're selling what you have, Allah will give you barakah. So in the online market, predominant factor which runs, say with Nifty or with Sensex or with commodity market, is people end up shorting all the time. What is shorting? Shorting means selling or excessive selling, even though you do not have the product. Panic selling. So what people do is, people play with the sentiments. Now, there was this very famous investor. What he used to do, he's probably one guy is Carl Icahn, but he's not a very aggressive, shrewd investor. But there is this one more guy who was known to invest only in forex, invest only in commodity, and invest only in indexes. So what he used to do is, he used to be a billionaire. So he used to invest billions of dollars to short a particular currency. So say, for example, in Malaysia, recently 1 year back, what he did, he shorted the Malaysian ringgit. In the sense, he sold $5 billion of contracts of Malaysian ringgits, which created a panic in the market. Why is so many people selling, or why such a big sell? So everyone started selling. Even though there was no product underhand, people started selling more. So they were like, for example, if you have only five people who have the product, 100 people are selling the product. There's oversale in the market. So what he did was, the moment the oversale panic came in, the market started falling. Because the sentiment starts falling, the market started falling significantly, the current currency started falling significantly. When the currency started falling, before that we realized that he bought significant future contracts of the currency, saying that this currency, I'm buying it right now, and I'm going to create a panic in the market. Once the market falls, he's going to make a significant revenue out of it. A lot of people end up doing these things when they have money. So when you do these type of things, that is futures and options, when you're buying something or selling something which you do not have, it is very easy for people to manipulate your investment. You are nothing but a pawn in the other people's hand. A billionaire will put his money inside, and the money will suddenly go up or suddenly will go down. So this is not the right way when it comes to investment. That's the reason Islam very clearly specifies, when you're trading commodity, if you're buying gold, give gold instead of currency. If you're buying silver, give silver instead of currency. So when you're trading with a commodity, trade commodity against commodity, barter system. If you're investing into a particular product, or if you're buying something, when you're giving the money, you should get this possession of the product, not even 2 days credit, which yet again is not Sharia compliant. When you are buying a particular commodity, you cannot, or selling a particular commodity, you cannot sell something which you do not have. So when you follow these policies of these factors, you will realize it will not be possible at all for any economy in the world to control our economy. Because if you follow these rules, the economy will be more stable, the economy will be very strong. And that's exactly why there were a lot of reasons why a lot of economies from different parts of the Middle East were taken over, because they started telling that they will deal with gold or silver in terms of currency. Next question, probably, brother, I have, okay, so I can take a last question. Brother, I have invested in various mutual funds since 2007. SIP 500 to 2000, SIP of 500 to 2000, Axis Mutual Funds, DSP, SBI, Birla, Sun Life, and many other. So as per your expertise opinion, nothing seems to be Sharia compliant. What's your opinion for me? If I quit, what about my approach towards investment so far? So this is exactly what happens with most of the people. Because what happens is, when you go to stock market, the stock market intimidates you so much that you have so many offers probably to make easy money. So when we say that this is not Sharia compliant, that is not Sharia compliant, they get offended, they get irritated. They end up saying, what is this? Everything is not Sharia compliant. How should we make money? This is too much of extremism. But people don't understand that Islam makes things very simple. What is Sharia compliant? Making things fundamentally strong and making things fundamentally safe. As simple as that. If you're following the Sharia compliant norms, if you see the Sharia index, or if you see the Sharia compliant companies have outperformed in the last 6 months, when the market had crashed significantly and grown significantly, they had outperformed more than 30-40% in the market. Because a company which is Sharia compliant cannot be influenced by anything outside. No economy can influence it, unless, yeah, there will be an effect, probably 5-10%. Market falls, they will also fall. But the company will not shake in terms of fundamentals. The company will not, lose its strength in the fundamental aspects when the companies come under the Sharia compliant category. So this is something which we need to understand, that when you focus on Sharia compliant concepts, it is difficult, but it has its significant advantages. And when I say about investing in stock market is a way to understand a company, invest in a company. Why don't you use this concept to invest in actual companies which you see around you? You can use these concepts to make things more beneficial, more beneficent for you around you, and not necessarily invest only in the stock market. Use this into your day-to-day lives to help establish companies around you, or establish new companies in a Sharia compliant manner, and you will see those companies grow significantly, inshallah. Okay, so we'll take a few questions later on after this, inshallah. So let's resume with what we have, and probably just give me a say 1 minute break, probably. So we can just surf through this, and inshallah we will resume our session in a minute or two, inshallah ta'ala. Okay, alhamdulillah wa salatu wassalam ala rasulillah. So let's start with the session. I hope we have just we gave a 2 minute break so that you can feel refreshed. You can funnel down the discussion which we had, and I realized that a lot of people have mentioned that I go a little slow, or I reiterate or re-elaborate on the concepts of investments. Don't worry, as I've suggested and as mentioned, I understand it's not easy for basic people or people with basic understanding to understand this. That's exactly why we'll be behind you for the next 2 or 3 months at least, to make sure that you understand things in the fundamental aspects better. Yes, I will explain whenever I feel that it is necessary, but you don't have to worry, you're not missing out on anything. We will be constantly guiding you and mentoring you so that you can become better individuals, inshallah. To start off with the next topic, how to invest in stocks. Now that is something which is very important, which is the whole fundamental of the whole session, and there's no doubts it is important. But how to invest in stocks, what are the fundamentals and what are the basics? So what I have categorized it as the basics of investing into stocks into whatever, because it has been so elaborate. Honestly, it was very challenging for me in the last couple of days. I was more worried because a lot of people were saying that, Jubran bhai, I have no basic understanding. Now it is like, I know a language, I know to speak a particular language, read a particular language. Now suddenly you ask me to speak the alphabets of that language, probably I might lose focus. Say for example, if you ask me to say the alphabets of Hindi language, I might not remember it all in the same format, but I can read it comfortably. Now, similarly with stocks, it's been so fundamental, it's become so basic. To funnel it down to a basic category is really difficult, because investing into stock market is more intuitive. It is more about your personality and attitude and your analysis about things than the basics. The basics will aid you, will support you, will help you become better at investment, no doubts. But it is more about how you make it subconscious, how you let it become a practice. Because an investor never stops reading, never stops analyzing, never stops absorbing. An investor always knows what's happening around him. An investor always knows what are the latest trends. An investor always keeps himself updated with the latest norms and changes which are happening in the market. An investor always makes sure that he's aware about what are the fundamental aspects which affect the companies he's invested in. So we will try to make sure we cover as much as possible to give you a basic understanding of what and how to invest in stocks. So the basic understanding will be first 25 basic trading terms. So I will talk to you about what are the different trading terms which I use in stock market. Like for example, right now when I use a few terms, a lot of people are not able to understand or follow. So I will try to elaborate on the most commonly used terms in the trading division, and then inshallah we will discuss about what is 52-week high and low, what are its importance, moving average, what is the benefits of understanding moving averages, what are volumes, how to study the foundation, that is debt, past prospects, future and management of the company, economic seasons, that is how the economical factors affect a particular business, understanding the business industry, which is very important, concepts like opening and low, open high and open low, or closing high, closing low, waiting for the right price to buy, that is waiting for the right opportunity, how to keep yourself updated in terms of news, what are the tools to use, and what are the different impacts world markets have, and the crucial world indicators, basically, which act as a significant support or significant impact on the companies or stocks. What are the 25 stock trading terms? First term, buy, which basically a lot of people use, buy or going long. Now, by going long, people mean that you're buying a particular stock and you're going long in terms of investing into the company and being involved in the company. So when you use the term buy, it means you're particularly buying a share or a company, or you're buying a particular contract, which other people use in different terminologies in newspaper articles. Sell, as you all understand, is selling a particular stock or a particular product. Ask, ask is something which is a technical term used when someone is looking to sell their stock at a particular price. Ask price. Now, for example, if I'm selling a stock, the market price of the stock is trading at 100 rupees, but I am asking for 102 rupees. So amongst so many thousands or lakhs of people, only a few probably will be willing to buy it at 102 rupees. So ask price means you can place a particular order saying that, okay, even the market price is at this, if the price reaches this value, sell my particular stock. So when I say ask price, it means the price at which you're expecting the stock to be sold beyond the market price. Bidding price, it is the price at which you are willing to buy the stock at. So someone is putting an ask price that could be bought only by someone who's bidding for that ask price. So what you say by bid price and ask price, it is something which involves the price at which you want to sell and the price at which you want to buy. Now, when you talk about ask and bid, that's when comes ask and bid spread. Now, what is an ask and bid spread? It is the difference of the pricing between the selling point and the buying point. Like, for example, there will be thousand people who are willing to buy the stock at 98 rupees. There are 1,000 people who are willing to buy the stock at 102 rupees. Now, the person who's selling the stock wants to sell it at 101 only. Okay, so that is the spread between 98 to 102, which is there in the market, which helps you understand what is the demand and supply for the product and how much is the liquidity of the product. Because if the bid and ask spread is more, it means the liquidity of the product is less. What do I mean by liquidity? The amount of people buying and selling the particular stock is less. So when I say bid and ask spread, it is important for you to see what is the difference between bid and ask, because when you see the difference, you will understand the amount of volumes or the amount of transactions which are happening in the stock. The more the transaction, the lesser the bid and ask spread. What is a bull market? Now, a lot of people would have heard that, it's a bull market and it's a bear market. Bull market is something which shows positive sentiments about the market. That is, if a market is growing and if a company is growing, it is called bull market. So whenever there is a positive sentiment, you say it is a bullish sentiment, not only with the markets, with anything else. So you have to understand the bull market is referred to as a positive market. Bear market is considered as a negative market. So it's either called bullish or it is called bearish. So it could be either positive, positive-ish, or negative-ish. Okay, what is a limit order? A limit order is a type of order which executes at this price placed for buy or sell. Say, for example, if you are you have around say 100 stocks of a particular product, and you are looking forward to sell only 50, that is considered to be as a limit order. Just give me a second, there is internet connection error here, just give me a second. Yes, sorry for the break. Yeah, so market orders. What is a market order? It is a type of order which executes as quickly as possible at the market price. Now, what happens is that when the market is significantly falling or crashing, and there is a heavy panic in the market. Now, you are looking forward to sell a particular stock at the price. Say, for example, right now you're seeing the price 100, suddenly it's going to 98, suddenly it's going to 96, then it's going to 95, and then it's going to 90. In that half an hour's time frame when the market is falling, if we place an order at 98, probably it will not be sold, but the market will keep falling. So that is the time when you come to a market order, means open to market sell. So when you just say market order, it means whatever price it's getting, it will sell it at that price. So even if you see on the particular index the value of the stock is 96 rupees, it might be sold for 93 rupees. So that is specifically what a market order is all about. So when there is a heavy panic buying or heavy buying or panic selling, that time you will not be able to get the price at which you're expecting to sell. So it keeps just it just keeps fluctuating. So whatever price the market gets on the spot, it's what it sells on. So that is called a market order. A day order is basically a transaction which is done on an intraday basis at a specific price, and at the end of the trading day, it is not completed. So that is what is called intraday. So sorry, it's not called intraday. It is what is where you're getting a delivery of a particular product. So you're buying a stock today, and at the end of the trading day, the stock is not closed. You're holding the stock. So that is called a day order. Now, what is volatility? Volatility is the fluctuativity of the stock, which happens. It goes on top, it goes down, it goes up, it goes, into different ranges. So, how to understand the volatility of a stock? A volatility of a stock is constantly integrated with the volume of a particular stock. Volume means in terms of how many people are buying, how many people are selling. The amount of cash flow, investment flow, which is happening in a particular stock shows the volatility of the stock, and this will help you understand how volatile the stock is and how much the stock can be more volatile in the future as well. Going long, as I discussed, is about investing in the long term and buying and holding a particular stock. Averaging down, when a particular stock is this is a very important concept. I would request all of you to give a little special focus to this. When you're talking about averaging down means where you are say, for example, you have bought a stock yet again, say at say 500 rupees. Now the stock I have bought at 500 rupees, and in another 30 or 15 days the stock has come down to 400 rupees. So now what do? My stock is in minus, and but how do I uh, either exit out of the stock in a faster manner with lesser losses, or how do I actually get into a stock in how do I exit a stock in profitability when the market is falling? So this is where we call averaging down, or the law of average, wherein you buy a stock again at 400 rupees. That's the reason why we say when you're making a portfolio in terms of investment, you do not invest 100% of your corpus back into the market. You split the corpuses into three halves. So 33% you invest in the market, the balance 33% you use it to average the stock when the prices go down, and the last 33% you use only when there is a panic situation in the market to make use of the best opportunity. So generally, if you're investing in stocks, you do not use more than 50 to 60% of your corpus fund. The 30 to 40% of your corpus fund will always remain for emergency situations. That is something probably will happen only 3 or 4 times in a year, but that's absolutely fine. In that 3 or 4 times in a year, you'll make an average probably for the whole year if you are done it wisely. So what is an averaging down concept? If you're buying a particular product at 500 rupees and the price of the product has fallen down, now let's keep it like this. So for all those people who do not understand the basic understanding of a stock and if it's going down, say if I have bought around 10 shares, okay, now if I'm bought 10 shares at a particular price of 500 rupees, now suddenly prices, I want to sell the shares in the market, and the prices of shares have fallen down to around 350 rupees. So what I will do is, at that particular point of time, to try to see how best I can get my return, I will buy approximately 15 shares at 300 rupees, 350 rupees. So the average price of my 25 shares will be somewhere between 430 to 450, or at least approximately around 430. Yeah, it should be in the middle value. So the thing is, tomorrow if the prices of the shares go to 430, I can sell all 25 for no loss, even though the market has fallen significantly, even though the stock has fallen significantly. So this is the concept of averaging, where whenever there's a fall in a stock, You use your corpus, second half of your corpus, to invest in the company, to take the balance shares, so that you can average the price and exit faster. Number one, you can exit faster. Number two, say for example, you have bought 500 stocks of a particular share at 5 rupees each, and then you see the market has fallen down to 3 rupees. You are buying 1500 shares at 3 rupees each, so you have around 2000 shares at an average value of 4000 rupees. Now tomorrow, even if 1 rupee goes on top, you will be making 2000 rupees and 500 rupees. So this is what and concept of averaging is. So even if a small portion goes up, your profitability will be able to come back to its neutral self, and you can come out of a panic situation or a negative situation easily. Capitalization, this is what the market thinks of a company in terms of value. So valuation of a company or the capitalization of a company is extremely important in stock market trading, because you have to know at what price you're buying a stock, whether it's overvalued or whether it's undervalued. What is a float? This is a number of shares which can be actually traded after deducting the shares held by the insiders. So this is the actual liquidity available in the market for buying and selling. Say for example, if there is only 50,000 shares of a particular company floating, and if I have the money to buy all the 50,000 shares, the moment I buy those 50,000 shares, all the share price will go into an upper circuit freeze. What is an upper circuit freeze? It means there is no sellers in the market. Whatever sellers were there, I bought the shares from them. And once I bought the shares from them, I'm not willing to sell. So when I'm not willing to sell, there'll be a freeze in the stock, upper freeze or a lower freeze. Similarly, if someone is constantly selling and people are buying and no one is willing to buy the stock anymore, people are only willing to sell, it is called a lower freeze. So it's either called a lower freeze or upper freeze, or upper circuit or a lower circuit. This is directly related to float. That is the amount of shares that are traded in the public platform, and based on that you can actually decide that if you put a particular value in this company, whether the shares will go on top or not. That is exactly why when companies or big investors like Warren Buffett, Carl Icahn, or other big people invest in a company, the prices of the shares immediately start rising, because first thing, they are buying major share in a huge chunk and huge value. So there is not much of float in the market. Second thing, the sentiment is high, that someone like this is putting so much of money, so let's also invest in the company, and we end up everyone else also starts buying shares. So when they see that so many people are buying shares, people will stop selling their shares so that they can get a better price for the product. So this is yet again technical. So it's like you're going to a market and then you see that a lot of people are buying a particular product. Say for example, I run a restaurant and I go to a college. So when I go to a particular college and I put a food stall, so I see that the best way to attract or to get my products to be sold out is I make sure that when I'm cutting the shawarma or putting the biryani, there are 5 people standing. So probably we initially take, it's a marketing strategy, we take 1 or 2 minutes extra to give the product, and seeing these 5 people standing, another 10 people come, and looking at these 15 people standing, another 10 people come. So that is exactly how things move in terms of demand and supply. So this is exactly what happens in the stock market. So people, when they start buying, when the sentiment is there, why are people buying? People will stop selling because they think that they'll get a better price in the future. So this is what float is all about. Authorized shares, this is the total number of shares that a company can actually trade. So every company has an authorized share value, where this is the only shares which is trading in the market. So within that authorized share value is what the buying and selling happens, and that's what creates the demand and supply. IPO, initial public offering, it is when a company is going from a private company to a public company, where people from any part of the world can invest in the company and take the shares. So it's called initial public offering. Secondary offering is basically another offering in order to sell more stocks and to raise more money from the public. But secondary offerings are not done more often. It is basically done by big, large investors. So what they do is they give a secondary offering to get the investment from the market, but probably once in 10 years or once in 15 years or once in 20 years to get an additional revenue. Say if I've made 20 or 10% of my company public, and that 10% I'm able to generate a return. Say for example, Saudi Aramco only published authorized shares of 5%. That's it. Not more than 5% were authorized shares. For that 5%, they were willing to generate approximately around 20 to approximately $100 billion. So that is the target which they had. $100 to $200 billion is what they wanted to raise, issuing that 5% share value. Now, if Saudi government says, I want more money, I want another 100 billion, so they will give this as secondary offering in the stock market, and they'll offer another 5% shares in the market for another 200 billion or 100 billion. So that is what is secondary offering. Dividend, it is the profitability which is given by the company to the shareholders at the end of the year, or at the end of whenever they feel comfortable. Probably it's done only at the end of the year. Very rarely companies give half yearly. So a broker is a platform, or sort of a person who helps you buy or sell stocks on your behalf. So broking firms means they help you buying and sell stocks. So something like what we said, we associated with Religare, where Religare takes care of the broking part of it, and they buy and sell the stocks on your behalf if required, or you can do your own buying and selling on if you require that as well. So exchange is a place where different types of investments happen. So stock exchange, a forex exchange, commodity exchange. So it's like an index where different buying and selling is happening. So that is considered to be an exchange. What is a portfolio? Portfolio is a collection of investments owned by you, where you make your own portfolio, wherein you can have 5 or 10 different stocks of different industries. You can use it to diversify your portfolio and make your own portfolio. Margin account lets a person to borrow money from the broker to buy shares. So what happens is, most of the time in stock market, a lot of people end up buying shares. Say, for example, if I have 100 shares of Reliance, and that is a value of 2 lakh rupees. So for that 2 lakh rupees as margin, they will borrow another 7 lakh rupees from the broker. And they obviously pay some interest or some small fees on it. But they end up buying for 10 lakh rupees for a value of only 2 lakh rupees, which they have, and try to make money out of the 10 lakh rupees in the market. And that is what is all about margins. So this is something which a lot of people do. So if they have 1 rupee, they will buy for 7 rupees. And the product goes even 0.25 paise top. They make money for the whole of 7 rupees, and they make an exit, and they are very happy. So margin investments are yet again not considered Sharia compliant, because if you're paying a value for what money you're borrowing, it is more or less paying riba. Now, sector, a group of stocks in the same sector. So different industries considered sector-wise segmentation. So pharma is a sector, IT is a sector, and these are multiple things. Now let's come to the next topic. The 25 basic terminologies we have been able to discuss. Now comes the day's high and low. Now, day's high and low is a very important factor to understand the momentum of the stock, to understand what price are you buying at, whether it's the right price or not. Now, when it comes to day's high and low, it gives you an idea about how the stock has been moving the whole day, and whether you should enter right now or or you should not enter right now. Say, for example, Reliance, now it shows 2209 was something which was at 9:50 a.m. in the morning. Now you have to also understand something, as and when I keep getting inputs, while talking, I will share with you. So the most aggressive time in the stock market is opening time and the closing time. When there's heavy fluctuativity, heavy upside or heavy downside, is during these times. That is the first 45 minutes, the first 1 hour of the market in the morning, and in the evening before it closes. The stock market timing is between 9:30 to 3:30 p.m. 9:30 a.m. to 3:30 p.m. And during this time, you can say the last 45 minutes and the first 45 minutes are the most aggressive sessions. And probably in the middle, somewhere around 12:30 to 1, when the UK market opens, is when there will be a next wave of fluctuativity. So you have to understand, stock markets are like a chain. It's like a cycle stand. So one falls, the other keeps falling. So it starts with US in the night, then it goes from US, then you have Japanese index, then you have Singaporean index, then you have Indonesian index, then you have the Indian index, then you have the UK index. So it's a cycle. So if one index falls, simultaneously the other index falls. If one index grows, simultaneously the other index in different parts of the world will grow. So that is exactly what is similar here. So in the mornings and in the evenings, it is highly recommended you watch a stock. Don't invest at that time, because there's heavy fluctuativity, because suddenly the stock will go up, or suddenly the stock will go down. You invest a stock when it's more stable, when you have a better idea about what the stock is going to fetch for you. So the day's high and day's low is very important for you to understand what is the momentum of the stock in the day, and what price are you buying. Are you buying it at a overvalued price, or are you buying it at an undervalued price? So at the end of the day, you have to understand, say, for example, during the mid of the day, if the stock has gone in a particular high at 2218, now suddenly at 2:30 a.m. you see that the stock is breaking 2218. So breaking and going on top, it means the stock is going to make a rally of another 30-40 rupees. So it means the stock is going to grow. So this breaking of rally, this breaking of day's high is a positive sentiment that whatever high the stock made in a particular day, people are willing to buy more than that. So whenever you see days high or days low, whenever you see a price is fluctuating around that barrier, you can understand whether the stock is going to either break it down, break and go down, or break and go on top. So that is the time where you have to be a little careful during the around the days high and around the days low, where you have to see the momentum of the stock. Probably this does not affect the stock that much as a 52-week high, because a 52-week high, if something is breaking a 52-week high, that is a 1-year high, it means after 1 year there is so much of positive sentiment the stock will grow. Once it breaks that barrier, it will have a big rally of at least 10 to 20%. That generally happens with a lot of stocks which break a 52-week high. So this is about days high and days low. This helps you understand the momentum of a stock. This helps you understand whether you're buying the stock at the right value or not. And this helps you understand whether you should enter the stock today or not. Because if the stock is next to the day's low, it is better you wait for some time and see whether it is breaking it or not. If it is not breaking, probably you can buy it at day's low, and then tomorrow you can hope for a better rise in the stock. 52-week high and 52-week low based on daily closing prices for the security. So what is a 52-week high? It is a 1-year analysis of what has been the highest price in the year and lowest price in the year. Now, similarly, when the lockdown happened in during March 24th in India, that time there was a negative news in the market from March 15th to March 24th, where they stated that Reliance has had a significant fall because the oil prices went to zero. So when the oil prices went to zero in terms of future contracts, Reliance share prices crashed, because major of Reliance revenue is from the oil projects they have, offshore oil wells. So the company immediately crashed to 875 rupees. Now this is where we realized, with our experience, that a company with a good management, a strong management and strong business plan and a good existing track record, no matter what the panic situation, will make the best out of it. So that's the time when you have to invest. So I, at that particular point of time, did suggest a few people to invest in these companies. That is a few close friends of mine. Provided the companies, you see, and how it is, at 840, 850 is a good price, I think we can buy. And at that particular point of time, when we bought the stock, a lot of people felt that it's a stupid idea to buy a stock. But we were hoping that the stock fell from 1,200 rupees to 800 rupees. Is a huge drop. So at one particular point, and it was a 52-week low. So it breached the 52-week at 1,000 rupees, and then it came to a 52-week low of 840 rupees. And there we told that, why don't you buy? Because the stock has already fallen 20%. There is no much chance the stock will go more than that, because how much more can you sell a quality company? So when someone buys at that particular point of time, you bought at a 52-week low, then the stock started growing. The stock started growing at a certain point where it crossed the 52-week high of 1,500 rupees. The moment it crossed the 52-week of 1,500 rupees, the stock next touched 2,500 rupees. Now, what does this indicate? When you go with the momentum of the whole year, when it is breaching a 52-week low or it is breaching a 52-week high, there is heavy momentum which will follow after it. So if at all you are buying a stock which is going to breach a 52-week low, the high chances you're going to make at least a 20% loss in your investment. Similarly, if you are investing in a stock which is just about to breach the 52-week high, there's heavy chances you can make a significant return in that investment as well. All what I'm saying is on a fair bit of analysis. It is not a sure shot return. It is something which we have seen over a span of time, which has been able to develop good returns for our investors. In terms of volumes, next volume basically is the amount of buy and sell that is happening. Stock, the amount of people who are investing in the stock, who are buying the stock, who are selling the stock, is what is considered as volumes. Remember, I had spoken to you about volatility. Volatility and volumes go hand in hand. A lot of people need to understand and see the volumes at which the stock is trading. Say if you see in the whole day, you will see the volumes of the stock will be high in the morning while opening, in the night while closing, and in the afternoon. So whenever there is high volumes, you can expect the stock to rally a certain value, and you can expect a stock to fall a certain value. So whenever you're going to buy a particular stock, see whether the stock is having high volumes. If it is having high volumes, It is better you involve yourself into the rally for a month or two, and then you can make a benefit out of it as and when required. So volume indicates how many shares are bought and sold over a given period of time. The more active the share, the higher the volume it would have. Volumes are used to confirm a particular trend, a positive trend, a negative trend, a bullish trend, or a bearish trend. So 100 shares if you buy and 100 shares if you sell, that does not make the volume 200, that makes the volume only 100. So you have to understand this is an important factor to analyze what volumes are all about. At the end of the day, volumes indicate the cumulative volume across trades executed throughout the day. So basically, how many people have bought, how many people have sold, how many shares have been floated in the market. High volumes indicate the presence of smart money, that is, people have trust in the company. People feel that, if we invest in this company, right now there's a significant increase in volume. Say, for example, if there have been only 5 lakh people trading in terms of volume in that share for 2 months, and suddenly in the third month you see 7 lakh people are trading that share, it means there's some inner sentiment which is going on. People are trying to make use of the money smartly, and there's something going to happen. So the increase in volumes signifies there's either going to be an increase in price or there will be a significant drop in the price. Low volumes indicate retail participation. That is, when you have low volumes, it means big people are holding heavy chunks of stock, and the stock is not going to move fluctuatively. It is going to be very stable. So when there are low volumes, it means the stock is very safe and very stable. It's going to consistently grow only when it is required. When you initiate a trade to either go long or short, always make sure you check the volumes and you confirm. And always try to avoid trading on days with low volumes in a particular stock. If a stock has an average volume of 5 lakh shares to be traded a day, if it's trading only 2 lakh shares today, it's better you do not invest in that company today. Probably you can invest in the company tomorrow, or when the volumes are significantly higher. Now, something which is very important for me, which I personally find tremendous value with, it is called moving averages. Now, with moving averages, what I mean is different types of averages: 10 days average, then you have daily average, you have 52-week average, you have 200-day moving average, you have 100 a few odd days, you have different types of moving averages. Now, as I told you, what is the most important factor is to see, first of all, whether the stock is overpriced or underpriced. With these averages, you will know whether the stock is priced or averaged in a significant manner or not. No, sorry, priced or valued in a significant manner or not. Say, for example, if I'm buying Reliance right now, if I see that the stock has a good average in the last 1 year, if I'm able to watch these different averages and I know it's breaching a particular average, it means it either has a positive trend or it either has a negative trend. So these averages, if it becomes subconscious for you, it will help you significantly investing in a particular company confidently. Now, averages is something which you do not go by looking at graphs, or you do not go by seeing different patterns or charts, because graphs, patterns, charts are just a basic way for you to start investing in stocks. But eventually, it is what comes subconsciously, what comes intuitively is what you have to do in terms of investments. Because once you start observing constantly, once you start absorbing the knowledge which is important for you to become a successful analyst in terms of understanding the stock, naturally you will know it's breaching this average, so probably invest here, or breaching this average, probably sell here. So this is something which is very important. I would request all of you to spend some time on a daily basis to study some averages of the stocks you're investing with or dealing with. Subconsciously, you will know if this particular stock comes at this price, for sure you can blindly buy, because these averages is something which gives you the range of a stock. So, for example, my particular way of investing is I have a list of 20 stocks which I feel are Shariah-compliant and strong. Those 20 stocks I've been following for almost 10 years. Now, if you wake me up from my sleep and also tell me the stock is at 700 rupees, can I buy? I'll say buy. Blindly buy. At any point of time, this will at least go up 100 rupees, and you sell it that time. Okay, so now this is because it's subconsciously embedded in me. I know if Infosys is at this price, I should buy. I know if this company is at this price, I should buy. So that sort of average registration in your mind that the stock is at this value or stock is at this range, that comes only when you constantly watch the averages, constantly you see the ranges. So you will know that the stock is at the right price, and surely it will trend back from here. So that is the rally which a stock has, which all of you need to subconsciously understand, and that comes only when you are constantly observing or constantly seeing a stock on a regular basis. So the average is taken over a specific period of time. The most common applications of moving average are to identify trend directions, and to determine support and resistance levels. Say, for example, if you feel that it's going to breach a particular value, it means it's breaking its support. That is called a support. So say, for example, if you are climbing on top of a hill and you're falling, you need a particular platform or a cliff to hold upon. If there is no cliff, it's a dead fall. Similarly, in stock market, when you feel the graphs are going top and when it falls, you will see it will always fall at a level where there is a support where there was a previous fall. So that is what is called support, that is what is called sentiment, and that is what is called resistance. This is something which is a core way of understanding a psychology of a stock and a market. This will not come immediately for the basic for people who are doing this on a basic format. This will come eventually, constantly. When you just keep looking at it for 3 months, 6 months, it becomes a more of a subconscious process. You don't have to read, you don't have to make an effort, you just have to observe. You have to let your eyes do the reading constantly, and inshallah you will be able to get the intuition when it has to happen. When asset prices cross over the moving averages, it may generate a trading signal for technical traders. As I said, when it crosses the necessary moving averages, you can either see a significant rise or a significant drop in the share. General guideline is, if the price is above a moving average, the trend is up. If the price is below a moving average, it means the trend is down. So this is something which we need to consider, and this is something which we need to understand in terms of moving average. Now, a very important factor in stock market investing is the 200-day moving average. Now, one of the famous billionaire investors, Mr. Ray Dalio, is supposed to be one of the most successful investors in the last 25 years. Probably his reputation sometimes surpasses Mr. Warren Buffett's reputation also, because of the way he invests. So Mr. Ray Dalio says that one big key way he understands a market, or he understands whether he should invest in a particular place or not, is the 200-day moving average. Now, what do I mean by waiting for the right opportunity to invest? What do I mean by finding out whether the market is going to collapse or not? Or how do you actually analyze what is going to happen in the market in the future? A market is basically it's a consortium, or it's a what do you say, pool of multiple people. It's a pool of psychology. So when you see the market, you understand the whole market grows or whole market falls only on psychological factors. It's purely sentiment. So what indicates this psychology, what indicates this sentiment, is the average, especially the 200-day moving average. Now, a lot of people during the 2008 recession crash, or during the other crashes, who made money were the people who were able to analyze and understand the 200-day moving average. If you go through all the successful investors in the stock market in the West, people who have made money during the big fall or during the big recession are people who knew how to understand and read the sentiment of the market, which comes with the 200-day moving average. Ray Dalio, Carl Icahn, and many other investors in the world who have made a huge fortune, Warren Buffett, are people who consider 200-day moving average, because that shows the sentiment of a particular market or a stock in terms of whether it's going to go up or down. Say, for example, if a stock is breaching a 200-day moving average, it means its sentiment is either going to go on top significantly or going on down significantly. Now, 200-day moving average is generally used regularly in the market by senior most investors to invest even in the indexes, or to even analyze an economy. So if an economy has a 200-day moving average breach, it means it's going to go down. If it's crossing a 200-day moving average to go on top, it means it's a benefit. Similarly, if a stock is breaching, it means it has a similar trend. So this 200-day moving average has been a key indicator for a lot of successful investors all over the world, that to understand whether the market is going to fall or market is going to go on top, whether it's going to collapse or not, it's going to go on top. So these are the key indicators which help you understand, okay, probably if it is going to breach a 200-day moving average or a 52-week moving average, or at least a 2-year moving average, it means something really bad is going to happen or something really good is going to happen. Now, this is what is stock market is all about. Now, so a lot of people think stock market is rocket science. It is not rocket science. Stock market is all about knowing your fundamentals right. If you can have your fundamentals right, if you have these basic things right, you will be a very good investor. It is not a big thing. Probably a lot of people might be thinking that during this session they'll be learning a lot of big things, candlestick theory, this and that. But honestly, if I have to tell you in a very fair perspective, investing in stock market is very basic, very simple. All you have to do is be disciplined. All you have to do is have the right attitude. All you have to do is not be greedy. Just make sure that you know exactly what you want, when you want, and how you're going to get it. When you get it, you have to exit. because once your target is achieved, if you wait for something like, okay, no, I'm going to get more money, no, I'm going to do something more, you end up letting your emotions take control of you. Remember, money is a bad master but a good servant. So then comes the next concept, that is how to analyze the economy of different parts of the world. Probably a few people would have understood this through my previous presentation, but let me give you a small idea. A lot of terms mentioned in this are not Sharia compliant, but why I'm telling you this is, these are indicators of market to go up or go down. Now, key indicators in the world market, as I told you, what are the products which affect the market? How does the global market affect the current market? And what are the other things which support or complement each other? Now, in this, if you understand, the when the economy is growing, there are few products which will grow, some underlying products which will grow. Like for example, when the economy is growing, you will see the stocks are growing, you will see the bonds are growing, you will see the commodities are growing, that is gold and silver is growing. Because whenever the economy is growing, you will see that these products are also growing. So if you want to understand whether a country is having positive sentiment or not, you have to see how the bonds are faring, you have to see how the stocks are faring, you have to see how the gold and silver is faring. But in countries like India, where there is heavy attachment and sentiment towards commodities, you will always see commodities will grow, and you will always see that they will always keep growing, even in a panic situation or even in a happy situation. So that is something which you're not supposed to consider in the Indian market. You are supposed to consider in the global market. So when I say global market, it means countries like US or European countries. When gold prices are going on top, when gold prices are increasing, it means there is a heavy chance that the economy is going to collapse, because that is the place where investors look forward to invest in. That is the place where investors look forward to be investing whenever they feel there is a risk, because commodities is the underlying factor for any currency or any economy, and it's always a safe and a liquid option to invest in. So the second thing, if the inflation is high, what is inflation? Does anyone have an idea what inflation is all about? Someone please interact with me. I need to see some people responding. What is inflation? Let me see the charts. Inflation is rising in prices. Anyone else? What is inflation?
Consumables becoming expensive.
Mm-hmm. Consumables becoming expensive, and probably people say that when the inflation is high, the economy is going to fall, and many other things. So these are the things which you see in the news in many places. But as the brother stated, when inflation, by inflation, it means the power of purchase of an individual in a country. So when you say inflation is high, it means the power of purchase of people in a country has reduced. When you say inflation is low, it means the power of purchase in the country, the power of purchase of an individual in a country has increased. Okay, so inflation and interest rates are directly proportional, or sometimes they're inversely proportional as well. Okay, so say for example, if the power of purchase has increased, if the inflation is low, you will see that there is a low interest rate in the country. If the inflation is high, you will see there's a higher interest rate in the country. So whenever you try to reduce the interest rate, the inflation also reduces, because once you're making the cost of borrowing money cheaper, people will start purchasing more. So that is the whole concept of inflation, that is the whole concept of interest rates, and that is the whole concept of how the market works. Now, if you are able to understand inflation properly, if you're able to understand what all things inflation affects, you will be able to indicate, or you will be able to analyze whether a country is worthy of investment for the next 1 year, 3 years or not, or whether a stock is worthy of investment for the next couple of years or not. So inflation, when it's increasing, you will see that you have commodities like gold increasing, and inflation linked bonds also increasing. Like for example, government bonds which are involved with the economy, they will increase. So what many people do when they want to invest in a particular country, they will see how the bonds are faring, because that has the actual sentiment about the core of the economy. So say for example, no matter how much our government says that we are in strong hands, our share market is growing, this is growing, that is growing, these small indicators will tell how hollow our economy is. So this is something which will help you understand the sentiment or the foundation of an economy. Falling economic growth, you will always see there will be a fall in the treasury bonds linked to inflation. And similarly, if there's a falling inflation, you will see treasury bonds and stocks fall again. So this is not a black and white theory or something which is 100% this thing. It's purely more like a indicator. If you see these things, you will be able to have a better idea and understanding of things, so that you will be able to invest in the economy or in the country or in the particular stock. Say, if I'm talking right now, it's not necessary that investing in the Indian stock market is only what is the key. You can invest in the Indian stock market, or you can invest in any other stock market based on which country you are, provided you know these fundamentals well and right. The next will be industry analysis. As I've told you that for investing in any stock, it is very important that you understand the industry very well. What is the definition of risk? So when I talk about industry analysis, let me tell you, let me ask you a question. What is risk? Can anyone type what risk is? Can anyone say what risk is? One second, let me see the chats. Example is Chennai property. Okay, what is risk? Risk is reward. What else? Anyone else has an idea? What is risk? In investment terminology, exposing to danger. Okay, potential to lose. Okay, the amount of loss one can take. Okay, uncertainty about earning, probably. Okay, this is something which are the consequences of risk. But what is the definition of risk in particular? The amount of loss one can take is a consequence, or probably a factor which you're willing to take a risk about. But what exactly defines risk? Say, for example, if I say I'm making an investment, I want it to be risk-free. Obviously, no investment can be risk-free in Islam. But in my mind, it is risk-free only when this is the definition of risk. You can understand this. Once you understand this, you'll have a better idea about what stock market is. Risk comes from not knowing what you are doing. The moment you know what you are doing, you eliminate the concept of risk. So the moment you are analyzing your investments, the moment you're analyzing the industry, the moment you're analyzing where you're going to invest, what you're going to do, that shows you that you have eliminated the risk in your mind. So a successful investor is a person who never gets affected by risk. Probably market sentiments, the market has crashed, Corona has come, COVID has come. These are different things. But a successful investor will always make money even during risky times. If you see, Jeff Bezos became a $200 billion man during the most riskiest times. Apple became a $2 trillion stock during the most riskiest times. Tesla, Elon Musk multiplied his wealth 1.5 times during these risky times. Mukesh Ambani became the fourth richest man in the world during these risky times. Basically, the top 10 richest people, Mark Zuckerberg, Facebook became one of the most valued companies. Zoom, one of the most valued companies right now. So if you see all these people, if you see, the fundamental factor is they know exactly what they are doing. They know exactly why they are doing, and they know what is their target. So the moment you know what you are doing, the moment you know why you are doing, you are eliminating the quotient of risk, and you are adding a value of high success to your portfolio, not only in stock market but in your life as well. So I would encourage and suggest people that if you are saying stock market is risky, it is only when you have no idea about what you're doing. The moment you have an idea about where you're investing, what is the information about the company, what is the right industry, whether it is the right industry or not, what affects these industries, what is the competition for these companies, or what is the competition for this particular industry, are you able to forecast what is the future demand, are you able to analyze how the company grew in the past, do you know everything about what investment you're making? People will say this is too much to do. Okay, yes, this is exactly what investment is all about. If you do even if you make one investment right or two investment right, you're going to reap the fruits for the rest of your life. So it is very important that you eliminate the quotient of risk by actually understanding what you're doing completely. Now, there is a difference between people thinking I know what I'm doing and people knowing what they're actually doing. Now, a lot of people end up thinking that they know what they're doing because of what experience they have or probably what analysis they've done. But when you're saying eliminating risk, it is not only by self-analysis, It is by discussing with mentors, it is discussing with successful people, it is discussing with industry specialists. Only then you will be able to have a better idea about what exactly the industry is going through. Say for example, now when in March the value of crude was falling, that is the value of oil was falling, and at that particular point of time you would have seen that Reliance was falling significantly. Now if a company if an investor has invested in Reliance, what is the way he could have hedged, or what is the way he could have given an alternative investment which could have worked against this loss? What is a hedge? Hedge means if I'm buying something now, and if this is falling, this will go on top. If this is falling, this will go on top. That is a hedge. So that balances your portfolio to avoid risk. So what probably could I have done in the stock market if I had a company which is investing in oil to hedge my risk? Just a brief understanding. Probably this could be technical, but just give me a brief input about how you're thinking. Just tell me what do you think about risk and how it could work. I mean, how you can hedge. Probably if you are investing in a company like oil and gas, you have to see what are the companies which get affected by the oil prices going down, and what are the companies which benefit with the oil prices going down. So that is how you analyze a particular hedging concept. So if I would have invested in Reliance, and I know that by investing in Reliance, if the oil prices go down, if the Reliance stock will go down, I'll also invest in a company where if the oil prices go down, the stock price will go on top. For example, Asian Paints, or for example, any paint industry. Now, just because I'm taking you these names doesn't necessarily mean it's always Sharia compliant. I'm giving you examples. So if I would have invested in Reliance, and if I have invested in Asian Paints, I would have balanced out my portfolio. I wouldn't have made a huge loss if either of the stocks would have fallen. So if the stock has fallen, I would have made money in Asian Paints, because paint industry predominantly focuses and depends on crude. Without crude, without oil, you cannot make paints. The lower the price of oil, the lower the cost of making paints. So the more the price falls for oil, the more the value of the more the margin and profitability of paint companies increase. Similarly, the more the dollar becomes stronger. Hello, yeah.
Yeah. Assalamu alaikum. The thing you said about hedge, like, will it only be used for balancing the portfolio, or we can even make profit through that? Since you said that we need through this hedge thing, we need to buy stock in both the industries, like where they affect in going high prices and where they loss. Like,
yeah, brother. So brother, what I would do is I will explain to you this. So probably if you have a question, you can raise a hand, and I'll be giving you the opportunity to ask the question in the question answer session. It's just there in the next 2 minutes. But anyways, since you have asked the question, I will answer it. You're saying that they asked me 2 questions. One was, can you use the hedging concept just to balance the risk or to even make the profit? It's up to you. If you do a hedging right, you can make the profit and you can balance the risk as well. Say, for example, what other people do in the market in a non-Sharia compliant way of hedging is they buy a particular stock and they sell a particular contract. So what happens is, if I'm buying Reliance in the cash market, I'll end up selling the futures of Reliance in the futures market. So if Reliance goes on top, I'm making money. If Reliance goes down, still I'm making money. This is not Sharia compliant, because you are bidding on something which you do not have. Now, the thing is, probably you can use different industries to hedge each other, but you cannot use the same, you cannot buy and sell in the same place, right? You cannot have a selling contract and a buying contract. So basically, you have a selling contract which is constantly there for a month. If the prices fall, probably you'll make money. If you have a buying contract, the prices go, you'll make money. That is not Sharia compliant. But yes, you can have a hedging concept between industries where you can similarly, as I said, if the currency, that is dollar, is becoming strong against the rupee, what you can do that time is, you will know that IT stocks are going to go on top, because all the IT projects come to them in dollars. They have a dollar account separately, so they keep that dollar there. So if the prices of dollar goes high, they will be making at least a couple of billions in a year in terms of rupees profitability. So that is going to add significant value for them. So you have to see what can hedge a particular investment. So some people, they do, if they're investing in a company which if they have dollars physically in their hand, if they're into forex, Probably if they know if dollar is falling, they can simultaneously buy a stock in an IT company just to see if they can make the margins out of it. Okay, so when I'm saying something like this, it's not a direct correlation of hedging, because what people understand about hedging is, if I'm making money here, I should lose money here. Or if I'm making money here, I should lose money here. That's not hedging is all about. If there is a risk in a particular industry, what can nullify that risk in any alternative industry or any alternative strategy? But it should be Sharia compliant. So this is what hedging is all about, and this is what understanding risk is all about. So I would highly suggest, encourage people to know exactly what they're doing, to know exactly where they're going to invest and why they're going to invest. Do detailed research, do mashwara with industry experts, understand before you're investing a stock, because you need to understand investing in share market is not about buying one or two stocks. Whenever you invest in a company, always consider you're buying the company. Say, for example, if you're buying 100% of the company, what would you do? So if you're buying 100% of your company, what all things you will see, what all things you will understand, what all things you will analyze. So whenever you approach a stock, always approach with the mindset that you're buying the whole company. So that way you will know exactly the risk and you will analyze things in different ways. So probably we'll go with the question answer session for another 15-20 minutes, just to give you a small break, and then we'll go to the next topic, which will be the market analysis. So let me see what are the questions which we have received. So there was a participant who had asked, indexes are associated with base year. Which year is it now, and how does it influence the market value of shares? See, the thing is, I personally, I'm not a person who focuses on index. I am not a person who personally believes that index is something which indicates heavy amount of investment inflow. I personally am a person who believes in individual industry, individual company, individual investment. So if you go with the indexes, probably it will help you some basic understanding of 20-30% to gauge the market. But going with the index in terms of base year and in terms of value of the share is not something which probably will add any value, because say, for example, if Reliance is growing, the index will keep growing, even if all the other companies in the index are falling, because Reliance has around 12% of the index share of Nifty. If Nifty is growing, Sensex will grow. So the thing is, all you have to do to increase the index is make sure that the three large companies index is growing. So say, for example, if HDFC Bank, Reliance, and probably at Auro Pharma or one more another company is growing, the index will automatically go on top. Nifty will go on top 150, 200 points. Sensex will go on top 400, 500 points. So if you depend on the index to see the value, base value, you will end up losing more. Now, coming to the next question, that is Brother Abdul has stated, Assalamu alaikum, I have a question out of the box. Is investing into cryptocurrency halal? Your opinions? One of my friends keep following me to invest into cryptocurrencies. And this is something which I've been recently getting a lot in terms of cryptocurrencies, whether it is halal or not. The thing is, a lot of scholars haven't given any approval yet in terms of cryptocurrency, because cryptocurrency has no underlying factor. What are you doing with cryptocurrencies? What is the delivery you're getting in hand? Probably currency is backed against gold. Gold, when you buy, you're getting gold. Real estate, when you buy, you're getting property. But when you're buying cryptocurrency, what are you getting except a digital code? And who is controlling that digital code? What is giving the demand and supply? What if the person who has money is buying multiple cryptocurrencies and fluctuating with the market price? You don't even know who's regulating the industry. So if you look at all this, you understand there's a significant risk, because you do not know who's controlling and who's regulating the prices of that industry. So this way, I would suggest right now you avoid cryptocurrency for a while. Probably this can be done, I mean, not for investment, but say, for example, like we are working on a business model where we are going to create an halal ETF concept where people can buy gold and silver to deposit their capital in terms, and they can have a purchase, they can have a product in their hand. But if there is multiple people who have bought and stored gold, what can be issued against it? Probably they could be your own crypto, which you can issue as a company against it. We are in discussion with scholars. We do not know whether this will be approved, but I'm just saying a hypothetical idea, something like this can be done. But investing into crypto is heavily risky, because you do not know what is the underlying factor in it.
Brother Ashraf Ali Shakir, he has mentioned that if the particular stock keeps falling continuously, then averaging is good or bad. Now, here in this case, you have to see what are the factors that are, enhancing the selling process. If you feel that the selling is happening because the fundamentals are weak, or the stock is heavily exposed to debt, or the sentiment in the market about the stock is gone down, it's better you average more later at a significant value. Say, for example, if it's 500 rupees and it's falling to 300, then you average at 300. But the idea of averaging should be to exit, but not to make money. But if the stock has good sentiments, has strong foundations, and there is a heavy chance in 5 years or 6 years, or at least in 2 or 3 years, it will at least go to the price which is expected of it to reach, based on your analysis of the market, based on the exposure on debt. Because the lesser the company has debt, the more higher the chances it goes back to its original form. Second, if the industry is supported by right factors, say for example, if taxation clauses, or if borrowing in that industry has become cheaper, that industry will go on top. Demand and supply, you need to see what is happening or not. So based on these factors, if you feel a particular stock is falling on a temporary panic, it's fine for you to average and hold. But if it's selling because, say for example, one famous example was Yes Bank. Okay, now Yes Bank, not Sharia compliant, just an example. Now Yes Bank was a 500 rupee stock. It fell down to around 50 rupees in no time. Approximately in 3-4 years, it had heavy investors. It had a lot of outstanding. There was obviously some problem, but the reason why it started losing money was people started losing trust in the company because of the promoters. Now today, what has become a latest market trend is people are spoiling the trust of the company. Say for example, if you have seen in the middle last 2 years, there were 2 or 3 episodes in Infosys where there was a whistleblower saying that there is some unethical things happening in the company. Now, why are these things happening too much in the market these days? Because the panic is what is controlling the market. If the company is fundamentally strong, these panic things or these negative emotions, sentiments will not affect. But the moment the market feels that the promoter is not trustworthy, the management of the company is not positive, the management of the company cannot be trusted, no matter how good the company, the market will fall. Sorry, the price will fall. In that particular point of time, provided if you have a 4-year, 5-year plan, you can invest and you can hold the company and you can get your money back. Otherwise, if you're in for a short term or a mid-term, it will not be sensible for you to hold the company which has lost market face value and is heavily exposed to debt, and the industry is struggling. So that way, what you can do is you can probably average to see how you can reduce your risk, reduce your loss as much as possible, or at least get out of it without risk or without profit. So without loss or without profit. But if the other indicators, that is market sentiment, is strong, there is always a trust with the shareholders of the company, and you feel the industry has its strength in the future, probably you can hold the stock for a longer period of time. Muzammil says, does Saudi Aramco last year one IPO offering under Sharia compliant radar? Probably, I have not seen the fundamentals yet, but understanding Saudi Aramco, they haven't borrowed heavily from the market. They are more of a cash surplus company. They have approximately around $25 billion in surplus cash every year. So they are a significantly cash surplus company. So it should be, inshallah, Sharia compliant. But please do not take this. I would say ask you to study of your own. Don't take this as a fatwa or something like that, because I am not worthy of giving it. Mr. Hafiz has asked, from your lecture, I guess I can assume Reliance is Sharia compliant because I feel Reliance has a lot of debt. Till last year, Reliance was non-Sharia compliant. This year, Reliance has come under Sharia compliant category because Reliance has significant cash flow, cash surplus, and has a lot of equity invested inside the company where it's reducing its debt. And officially, it's called a debt-free company, but on papers, it is not yet completely eradicated its debts. But understanding the momentum, the flow, and the business plan they have, they will have to eradicate the debt to get a better share value and to get a better valuation of the company in the next couple of months. Because if they want Aramco to come inside for a better valuation, which is expected by Reliance, but which is not very sure because of Aramco's cash crunch situation, but it's high chances Aramco will come inside, in my understanding, because there are a lot of other reasons why Aramco will partner with Reliance in the future, in my personal opinion, but I could be very much wrong. But if Aramco has to come inside, if Reliance has to attract Aramco, because Reliance, the only place where Reliance is burning money is in the oil and gas industry. and Reliance is very desperate to have some oil and gas giant inside, which will take off that tension of them. Because if there's a company like Aramco which comes inside, Reliance doesn't have to worry about the cash flow and the retail market. All Reliance will do is sell everything to Aramco, and Aramco will take care of the rest. So this way, the oil industry of Reliance will not be fluctuative, will not be affected by the debts of Reliance, and Reliance will immediately lose the huge burden which it has. So I have a feeling they will at any point of time either try to associate themselves with Aramco. If Aramco is not in the picture, at least they will associate themselves with big oil and gas companies in Middle East, ADNOC, Abu Dhabi National Oil Company, or Kuwait Oil Company, or something like that. But they will go with someone big, because Reliance for sure does not have a capacity to stand in the market alone right now in the oil segment, especially in the Indian market. So right now, to answer your question, scholars have said that Reliance can be Sharia compliant. I just had a discussion with someone yesterday. Is Nifty 50 okay to do business with? Nifty 50, yet again, if you're going with options and futures, is not okay to do business with, because it has its own, as I mentioned, there is no underlying factor, it's only a contract. Anyone can manipulate, it's purely about bidding. Say, for example, today you have 10 crore rupees of cash just lying idle with you, can just decide to buy contracts in Nifty in long, and immediately Nifty will go on top. And you see, looking at that sentiment, other people will also start buying. So basically, in Nifty, a person who has more money is the king. So that's exactly what happens in Nifty. So people like us who have small money, when we invest in Nifty, it is purely just based on sentiment that probably it will go on top, it will go on down, or it's basically on psychological factors, which I would suggest we do not invest, because if you're investing, we should rather invest in something which we can own and have, if not now, later in the future as well. It's something similar to owning, say, for example, why we say that investing into commodity market online is not halal, because when you're buying a commodity online, you either make money or you lose money. But the thing is, if you actually do it in the physical market, if you're making money, you can sell, you can get your profits. But if you're losing money, you can at least have the possession of the product, and you can use it for something else, either now or later. But that money is not going to be a loss unless and until you do not book your loss. So that's the reason why online market affects the investment more. Similarly, Nifty is similar to something like that, because if you make money, you make, but if you lose money. But you cannot hold it and say that, I have not lost money, probably in the future I can make money. So I hope I could explain that clearly. But yet again, Nifty 50 is not considered Sharia compliant by scholars. Mr. Shahul Hamid, can we be able to analyze now with the current trend during lockdown of 200 days moving average? Yes, you can very much analyze the trends of a lot of stocks, because I've been personally doing that for the last couple of weeks and months. I've seen that a lot of companies which have breached the 200-day moving average are doing significantly well or significantly bad. So that has been a very good indicator in the market for us to analyze and study the stocks. Let me see if we have anything else, probably. Assalamu alaikum. Is there any website or documentation where we can see the list of companies under Sharia? You have NSE Sharia index, you have 500 companies in that, you have BSE index, and a lot of other things in that as well. So can you so you have to, we will provide you with a list of websites where you can use these to see whether the company is Sharia compliant or not, or whether a particular index where you can see these companies come under the Sharia category or not. So we will give it to you. This is for Sister Fakia. So now the one brother has said, can you please provide the list of Sharia compliant companies in India? It keeps fluctuating, brother, because there is no specific company which constantly is meeting Sharia compliant norms, unless and until it's a company which started with the intention of becoming a Sharia compliant company. So in India, there is no specific company which maintains the intention of being Sharia compliant. But yes, there are heavy chances they can suddenly go into debt or not. So you have to constantly keep reviewing the company at least half yearly or yearly to understand whether the company is Sharia compliant or not. And I would suggest you do the review, because yet again, risk comes from not knowing what you're doing. So we'll take a 2-minute break now, probably, and then we will go again with the next part of the session. Bismillahirrahmanirrahim. Alhamdulillah wa salatu wa salam ala Rasulillah wa ala alihi wa sahbihi ajma'in. Amma ba'd. So next we come to the next fundamental analysis when you're doing to study a company, that is what you're doing to study a company, that is market analysis. With market analysis, there are multiple concepts. This is a little technical part of things. You don't have to worry. These are just basic indicators. You don't have to be very stressed about understanding all of this. Probably a lot of people don't even have a basic idea about how to study these things. But what we are going to do is give you multiple indicators which you can probably use once in a while to make significant decisions. Now, in the market analysis, there are three types of analysis we have to do: technical analysis, fundamental analysis, and competitive analysis. Now, when it comes to competitive analysis, it is the famous Porter's five theory or Porter's five forces, which we use in which we learn in MBA or any other successful business management companies. So what happens in this is you learn how to invest in a company by gauging or understanding its competitive advantage. Now we'll start with technical analysis. Basically, in technical analysis, what we've discussed is about moving averages, charts, indicators, oscillators. What are the fundamentals? 52-week high, 52-week low, days high, days low, volumes, and a lot of other things like this. Now, when we go with fundamental analysis is basically about the industry, the economic conditions, the future outlook of the company in terms of profitability, how the company is faring, how the company's fundamentals are, how the management of the company has been, what is the debt of the company, and how the company has fared in the last 5 years, what the company will do in the next 5 years, a couple of other things like this. Now, so for example, in this particular concept, if what I would suggest is technical analysis, we have already spoken about. In fundamental analysis, there is something called intrinsic value, which you have to consider. What is intrinsic value? Intrinsic value means if you are looking to buy a company, example, how you have to look at it, the perception of looking at a stock. Say if I'm looking forward to buy TCS, Tata Global Consulting Company, it's probably $200 billion. Okay, value 200 billion value. If no, Reliance is 200 billion, so it's 150 billion. Okay, so now if I'm applying to buy Tata fully, okay, in how much time will they give me my money back in terms of cash flow? In the sense, if I'm investing 100% to buy, I'm willing to invest my money to buy the 100% of the company. If I'm buying, say, Tata today at say $100 billion, that 100 billion, in how many years can Tata pay me back in terms of cash flow? That is what it's going to be. So for example, if you feel that the company has enough cash flow to pay your money back in 5 years, 7 years, 10 years, or 12 years, this shows you the health and the strength of the company. So it is important that you analyze a company in terms of this angle. So when we say that, always consider when you're investing in stock as you're buying a company or you're owning a company, this is what we mean. So if we mean that if I am today, for example, leave stock market, if I say invest in my company, probably will come and see who I am, what I've done, what my track record is, what my education is, what probably I can give you, what my trust value is, what my face value is, and probably what is my surplus in the company, and if anything goes wrong, how will you take your money back? And if you have to take your money back, in how much time can I give you the money back? Do I have enough cash flow to give your money back? So many things you look. That's exactly what you're supposed to look in the company when you invest in the stock market. So investing in a company in the stock market, you have to consider how much cash flow surplus they have to give your money back in a particular value of time. So if you feel a company has a strong strength and strong cash flow in terms of investing in the market, and it can give you your money in terms of dividends itself, it means the company is safe and it means the company is going to grow. So predominantly, if you see all the top 100 companies in the world, are those companies who have a good cash flow and companies who constantly give investors dividends. Apple is a $2 trillion company right now. It's constantly growing. What is it doing? It does the same basic stuff, but it has its foundations right. It has a good cash flow model. So no matter what, the company will grow because it has created its fundamentals strong. No matter what, at the end of the year, the investors of Apple are getting enough dividends in hand. And whenever Apple has extra money, it puts money back in the market to buy the shares from the market. It's called a buyback. When you're seeing a buyback, it means they're spending money to buy their own shares. So people who have their stocks, they're giving them premium value to buy this shares back from them. So this is making the shareholders happy. This is giving a positive sentiment in the market. And at any point of time, you keep doing this, a company will keep growing no matter what they're doing. Because unless and until the cash flow is not affected in the company, the fundamental of the company will not be affected. Unless and until the cash flow is affected in the company, the fundamental of the company will be affected. Sorry. So this is something we have to understand. Now, when it comes to technical analysis and fundamental analysis, you have different ways to do it. The short term, basically, and then long term. Short term are done by traders. Traders are people who speculate. Now, there is a difference between an investor and a trader, or investor and a speculator. An investor is a person who knows what he's doing. An investor is a person who knows the risk he's taking. An investor is a person who comes in with a dedicated mindset, with a proper planning in terms of how much I'm going to invest and how much I'm going to get. Now, similarly, a trader doesn't do this. A trader invests with the intention of making money today or getting money within the next 2 days or as early as possible. So when you're looking forward to make money in a short term, it becomes more speculative, and this gives you a heavy risk. So this is where your technical analysis becomes weak. So if your technical analysis is weak, it means you're a trader. If your technical analysis is strong, it means you're an investor. The moment you become strong on your technical and fundamental analysis, you will always naturally go for a long-term investment. You will not go for a short-term investment unless and until you're too good with the concepts, and you know probably this is the range of the company. In every 3 months, the stock ranges between this price to this price. If I enter here, if I exit here, probably I will be able to make 100 rupee per share. Okay, that is a strategical investment based on your study about the company. Similarly, it is the time, it is the intent, it is the data, and it is the focus. These are the things which you have to consider when you are doing technical analysis. You have to understand with what intention you're going to analyze a company, what is the long-term perspective, what are the things you want to intend in terms of revenue. If you're going to go for a short-term revenue, you will never consider a strong data, a strong technical analysis or fundamental analysis, because with the companies which are strong fundamentally or technically are companies which grow slowly. So the thing is, a lot of people misunderstand that, companies who grow faster are companies who are fundamentally not that strong. The companies who grow slowly are the companies that are fundamentally strong. If you see, a lot of successful big chip companies are companies who have strong fundamentals, but they grow slowly. But this doesn't necessarily need to be a universal law. Obviously, there are companies which are exceptions, which can grow faster and stronger, but this is not a general perspective which you have to understand. Now comes the next concept, that is the Porter's 5 forces. Now, Porter's 5 forces is a very famous concept which helps you understand the competitive advantage of a company in the market. So these are based on 5 factors. That is the threat of new entrant in the business, bargaining power of a buyer, threats of substitutes and threat of substitutes, bargaining power of suppliers, and rivalry among the existing competitors. Now, these are the 5 factors, according to Porter, that gives you a significant competitive advantage in the industry. So when you are looking at any business in the stock market, you have to consider these factors. So now a lot of people who have, to all the people who are here in the session with me are considering these concepts only for stock market. But if you look at it in the other way, if you have a paradigm shift right now, all this is actually useful for you to start your own business also. If you're starting a business, if you're doing a business, if you're growing a business, you need to know your fundamentals, right? You need to know your competitive advantage. You need to have your technical analysis. You have to see in the last 1 year, how is my company grown? In the last 6 months, how is my company grown? What is the average I have done in the last 1 year? If you actually look at this as a businessman, you actually become an investor in the stock market as well as you become an investor in the live market. Okay, so I would suggest all of you consider this not only as a stock market session, probably as a session to become better in terms of individuals with the respective businesses you're doing. Now, when I go with Porter's 5 forces, probably we have another just 40 minutes left. So I will try to surf through things. I will not go in detail with Porter's 5. You can go online and you can search. You'll have a better idea about Porter's 5. It's a detailed concept. And this will help you understand things better. Then comes the next concept in terms of technical analysis, that is analyzing the historical prices, looking for patterns in terms of graphs, that is double top, double bottom, head and shoulder candle. These are some things which will come in the significant sessions. Probably we'll try to see how much we can push in today, because as we see, a lot of people want us to go slowly and more elaborate. That's the reason I'm pushing in the question answer session between every hour, so that I can spend more time in teaching you what are the technical analysis, because I have probably another a lot of slides for the next day as well. So technical analysis, you have to be able to add in the historical prices. You have to understand how to read a graph. You have to establish a trading range for stock price, and you have to also be able to know what are the resistance levels to sell and buy at. Now, these four things is an upgrade from the first things which I've told you. Now, this is the second level of basic understanding. So if you can have this as a 4-point strategy, you probably should have at least a 60% fair idea on where to invest, how to invest. Now, this is something which people consider very basic, but it is not very basic. Each of this topic has a very significant depth to it, like in terms of how to analyze a historic price, how to study graphs, how to read graphs. Now, all these things, even though they are technical, I always will suggest you don't go too much on technical books, but go more on absorbing it and go into intuition. Say, for example, if I'm looking at graphs daily, after a certain point, if I look at a particular graph, I will know this particular company will go up or down. It's just purely intuition. So like, use your knowledge to absorb and to sink in such a level that it starts speaking to you whenever it's required. Don't go very conscious with every investment. The more you go conscious with your investments, the more mistakes you will do, the more you will get stuck in the trap of the stock market, because stock market is all about trapping you with sentiment. Going up, going down, going up, going down. You try to go inside when it's going up, you try to sell outside when it's going down. So you end up getting stuck in the same trap. So it's better you go with the analysis, because that way it will give you a 3D perspective or eagle eye perspective. You will not go more on technicals, you will be more on intuitions, you will be more on understanding, and this will help you understand things better. So I will be talking to you about a few topics among this, that is graphs and trading range. As I told you, it will come only when you keep watching moving averages. You will have a basic idea how the stock ranges in a year, or in a couple of years. The stock has constantly been ranging at this rate, this price. Every year it increases 10%, then it ranges at that price. Every year it increases 10%. I mean, similarly, so the stock has a pattern, it has a particular routine. So if you can able to understand that routine and feel that routine, it will help you establish a trading range. And you have to understand what are the resistance levels, that is the 52-week high, 52-week low, or 200-day moving averages, where if the stock breaks the resistance, how it will fall and what will not happen, and what will happen and what will not happen. Now, just a brief outline on the different charts in the stock market. Now, this is something which probably a few people might feel it's fascinating. Yes, this is quite interesting, but there is no particular, what do you say, science to it or theory to it. It is actually more a person who is into graphs will understand it's more not technical, but it is more intuitive. So you have constantly, I'm talking about intuitive because it is important to let the market get absorbed into you. You let the market talk to you, because that's what happens, that's what helps you most of the time when you're investing in the market. So now there are so many graphs that I've like around the probably around 15, I think 3, 4, 5, yeah, 15 graphs we have mentioned. You don't have to remember all this. We'll give you probably these patterns in our mentorship program for the next 3 months. We will constantly guide you whenever is required. So there are so many types of graphs. Now let me explain to you probably why these graphs will give you an idea. Now there is something called double top here, where it says the stock is growing from particular price, it is going, crossing the red line, it's going on top, it is hitting a spot and again coming back, again it's hitting a spot, again it's going on top, again hitting the same spot. So it's going in a range. So when it's hitting, it means it's constantly being restricted. So there is a negative sentiment, it's not letting the stock grow beyond a certain point. That's the reason it's coming down. So whenever it's coming down, it is being hit by a resistance, because most of the time people feel that that is the bottom line for the stock in the buy and sell psychology. So graphs is all about psychology. Graphs is all about understanding the mentality of the investors and understanding the mentality of the people in the market. So if you look at it in this particular perspective, you will see that, the moment you feel that there is a double top, you feel that it is not going to affect the stock significantly. I mean, it's always going to go down, because if there is some hesitation or some effect on the topmost part of the graph, it means it's going to surely go down. So if you see all the stocks in the first column, it is double top, head and shoulder, rising wedge. All the stocks in the end have a target which goes down, because all the stocks are constantly hitting the top and then constantly going down. So whenever you see a stock hitting top down, it means it's going to go down, because there is something which is not letting it go beyond the rally which it's supposed to have. So the first three graphs prove to you that whenever the stock comes in this particular format, it means it's going to go down. Now, when you see a graph, the question would be, what type of graph should you see? Should you see a daily graph? Should you see a weekly graph? Or should you see a monthly graph? Now, this is something which you people have to understand, that you have to see all the graphs, but on the necessary or the things which are important, the things which in the way you are supposed to do it. Say, for example, you have to see a monthly graph, you have to see a yearly graph, and you have to see a daily graph. This way, when you average these three, you will understand the sentiment is positive or negative. So you have to be able to average these three graphs and see what is the sentiment based on your understanding of multiple graphs. Now, similarly, reverse it, mirror image. If you go to the next column, that is double bottom, inverse head, and falling wedges, you will see the stock is constantly falling down, but something is stopping, giving a resistance, and is going on top. In the double bottom, it's the same. In the inverse head and shoulder, it's the same. And falling edge, it's the same. Falling wedge, it's the same. So whenever there is a stock falling down resistance, falling down resistance, falling down resistance, there are higher chances that the stock will breach and go to a positive trend faster. And then coming to the next concept, that is the next type of patterns, that is the continuation patterns, where these patterns are generally used in a very flowy market where there's heavy liquidity, and you're looking forward for something on a day-to-day basis or something on a weekly basis. This will help you understand the trend of the particular stock on a daily basis. You might say the trend of this particular stock falling wedge is equivalent to rising wedge, but you have to see there is a difference between that. Rising wedge basically has three bottoms, and then the stock is going with four tops, and then it's going down. You understand? Now there is a difference here. Now this is purely this will not come with a basic understanding, because if you see the difference between rising wedge and falling wedge, is more or less the same. It is only the small difference in the last lap of the graph which is taking the stock either up or down. And that is exactly what 200-day moving average is all about. Now, if you see the sentiment of the stock, if it's breaching the 200-day moving average, in that, its high chances is going to go on top. If it is breaching the 200-day moving average down, the high chance is going to go down. So that sentiment which you're going to see in terms of graph is what you have to see in the 200-day moving average concept. And all of these graphs will help you understand the pattern and the study of the concept if you're going in terms of a 200-day moving average. So bullish rectangle, bullish pennant, rising wedge, bearish rectangle, bearish pennant. All of these are different names. Sounds fascinating, sounds interesting, but it's more about the sentiment. Where is the resistance? Where is the growth? So how is the stock growing in terms of a rally in a particular time frame is what will help you understand the sentiment of the stock in terms of bullish or bearish, or whether the stock will go up or down. Now, when it comes to bilateral patterns, ascending triangle, descending triangle, and symmetric triangle, if I talk to you about right now about these things, is a little tricky. It will be very confusing. So probably when we are doing your mentorship program, we will be giving you a one-by-one input whenever necessary for you in terms of understanding the graphs. That time we'll be able to give you better analysis, because if I tell this to you right now, it will be quite complicated for the people who have understood the basic concepts, and they might lose focus. So right now we will keep the last pattern for our mentorship programs. So probably when it's coming there, we will teach them about that, inshallah. Now the famous Japanese candlestick theory, it's quite famous in the market, but I particularly feel that graphs or candlestick theory is merely a tool to understand your investment model 20 to 30%. Balance is what you analyze in terms of what we've discussed in the past topics. So these are things just basically 20 to 30% is a big value, but it does not give you that amount of dependence, or does not give you that amount of confidence. Probably, yes, this gives you a good amount of analysis. It gives you a precision in terms of what you have analyzed about the stock. So just to give you a small brief, the candlestick theory was started by a famous Japanese man named Homa. Basically, why candlestick theory is so famous is because candlestick integrates four concepts in one. That is open, close, high, and low, which are the four important factors to gauge a particular stock. Since they integrate, each candle integrates open, close, high, and low, the whole candlestick theory chart helps you understand the stock more precisely, more clear in terms of trend, and more clearer in terms of what are the resistance and where the company will fall below its average or go above its average. So what happens is, in candlestick theory, you can also see a significant integration of the volumes. Now, this is something which probably I can explain to you here. Trading, basically, this one point which I mentioned here, trading is often dictated by emotions which can be read by candlestick charts. The candlestick actually has a very good knack of bringing in the emotions which the market is putting in. I'll tell you how. Now, for example, there in this particular slide, I've broken down what candlestick is all about. You can see the topmost point is the highest price of the day. The part where the candle is getting over, it is the opening or closing price of the day. The body of the candle is basically the amount of stock which is grown in terms of price, or the stock which has gone down in terms of price. So it's the if the stock closed lower, the body will be basically in black or in red. If the stock has closed higher, the body will be in green or in white. That's the volume in terms of the growth of the pricing. Opening or close again in the bottom part of the candle, and lowest price of the day. So this candle basically keeps fluctuating back and forth. While this candle is here, there will also be a significant volume chart. So whenever you feel there's a spike in the volume, you will feel this candle is going on top. So the reason candlestick is such a is quite interesting in terms of its graphical understanding is it has an integration of all the fundamentals we spoke. That is 52-week high, 52-week low, days high, days low, open, close, volumes. Then you're talking about other moving average indicators. It has different indicators all integrated in one. So if you go with a Japanese candlestick theory concept, it gives you multiple concepts integrated in one. But people who go into candlestick theory are people who go aggressively into technical concepts. Now that is something which is misguiding a lot of people these days, because when we say candlestick, a lot of people are starting to buy softwares, starting to depend on softwares to generate revenue. They feel that if they invest in technology, probably they'll be able to make better revenue and make better margins out of it. But excuse me, that is not the case, because generally with candlestick, what happens is it helps you understand the stock better, but just don't depend on it completely. Don't depend on the technical analysis, because technicality is to a certain extent, but it is what you foresee about a company, how you analyze the industry, what you see in terms of future is what it is all about. Probably in the early 90s when Amazon was launched, no candlestick, no theory, no technical chart, no company would have said Amazon will be the biggest company in the future. And probably Amazon is on the range to become a $2 trillion company, or the biggest company within no time, probably next 6 months or 12 months. Why at that particular time no one was telling it? Because no one had the concept to foresee the vision, the future, that okay, e-commerce will be the new world. Similarly, Alibaba, when Alibaba came in, no one had the vision. So we have to understand that in investment, to become a good investor, it is not about technical all the time. It is about what you feel the trend would be, what you feel the future will be, how you can vision the future to be. Like how Umar radiallahu anhu used to have a very famous quality called farasha. Farasha means he used to look at the person and say probably what could happen in the future, what he could end up doing. Similarly, when he went to do Umrah, he kissed the stone, and he told specifically saying that I'm kissing you because my beloved Prophet did it to you, otherwise you hold no value to me. Similarly, the place where the bayah happened of Hudaybiyah, where below the tree, a lot of people used to pray there. So when he went there, he cut off the tree, saying that tomorrow in the future people will use this place to do bidah. So what is the concept of this? Farasha means you have to be able to understand, visualize, see how the future will be and what it holds for you. Something to understand the markets better. Basically, the line chart is very simple way of showing the price movement. It displays the information with a simple line using a series of data points. It is the type of chart that you may be used to seeing in magazines and newspapers that shows us the price movements of the stocks and shares. But on the other hand, the candlestick shows the same price movement. However, it's made up of individual candlesticks. Traders prefer to read candlestick charts because they include more information than a line chart and can be more useful for making trading decisions. As I told you, it integrates a lot of concepts together. Now, this is one very famous combination of graphs, which probably you can understand to have a fair bit of idea, to have a competitive marketing advantage. Now, I would say that out of 10 chances, 8 chances, this graph will this particular momentum of this particular part of the graph, if you can see in a stock, it's sure for it to generate revenue for you. So this is the 200-day moving average line. Then you see a 50-day moving average line. And then when you see the 200-day moving average and the 15-day moving average crossing the lines, then for sure you can understand that the stock is going to have a significant rally, at least with a 10 to 20% potential. Now, this is not again, a hard and fast rule that this is what exactly it will happen. You have to understand when this is something which is a proven technique with research with a lot of other participants, a lot of other traders in the past. So this is something which 8 out of 10 times have proven successful. For me personally also, it is very successful, and probably I never studied this as a theory. I ended up seeing this only now when I was making the PPT, but this became more subconscious for me. Whenever I used to see that there's something like this happening, I immediately used to look forward to invest in that company if it's Sharia compliant. So, and this is something which probably is one of those tips where it's a sure, not sure, but it's more confident in terms of the graphical approach. If you see a stock in this particular pattern, probably 8 out of 10 times is a safer option to invest in, inshallah. Now, let me give you a brief, just a small outline about how the stocks have been in 2020 before lockdown and after lockdown. And probably in this, I'll try to give you some brief outline about the stocks, different industries, and how we can add value. So the first thing about Infosys, if you would have seen, in March 2020, it was 583 rupees. Now it is trading at 1,000 rupees plus. This is as of 15 September, but if you go to Google now and see, it is trading at 1,000 rupees plus. Similarly, if you see HUL, that is FMCG company, that is Hindustan Unilever Limited, which has all FMCG products, it was at 1941, now it is at 2124. Probably it was not a significant drop, but there are other FMCG companies which have made much more higher returns when it comes to their products and their sale during this quarter. Asian Paints was at 1683. Now Asian Paints is at 2017, which is again, you could say it's around a 35% increase in the last 6 months. Reliance was 800 something odd during March. This is 106 as of 16 March, but by March 20th, March 22nd, it was around 850 odd. And then after that, now it is touched 2,300 rupees. You're talking more than 100%. Similarly, HCL 450, now it is almost 800 rupees plus. BBTC. Now, BBTC is a unique company. Companies, they are of multiple types. Infosys is an IT company, Hindustan Unilever Limited, FMCG company, Maruti is an automobile company, Asian Paints is a paint company, Reliance is a petrochemical, as well as you could say a technological company or sort of a telecom industry. HCL again is IT technology, but it does other projects as well. Now, BBTC is a holding company. It's called Bombay Burma Trading Company. Now, Bombay Burma Trading Company basically is a company owned by Wadia brothers, Wadia group of companies. And the work of BBTC is it owns 52% of the shares of Britannia and 48% of the shares of Bombay Dyeing. So what the promoters, owners of Britannia and Bombay Dyeing have done is they have offloaded all their shares in one company, and the company only holds the shares, no expense, no outflow, only inflow. And what inflow comes is from the dividends of these companies, and they're just a holding company. Now, this holding company, BBTC, is a public listed company now in the stock market. So now, if you understand how to value a company like this, based on the share value of Britannia and share value of Bombay Dyeing, the company's value is significantly higher. So right now, you can see the stock is valued probably at from 950, it went to 1,400 rupees. Probably there's a potential the stock can increase another 600 rupees if the other two companies are sustaining the existing rally they have. So these are some different types of companies you can consider. Holding companies where outflow is less, inflow is more, there is more strategical involvement. And these type of companies might prove a little more safer for you in terms of investment, and gives you a different perspective in terms of how to analyze an investment also. Britannia was at 2,600 rupees. Now it has crossed 5,100 rupees. I'm sorry, 4,000 odd rupees it has crossed recently when I saw 4,400 or something. So this is as of September 15. So Britannia has grown significantly compared to Hindustan Unilever, both FMCG companies. Pharmaceutical companies, Dr. Reddy's was at 2,800 rupees, 2,600 rupees. Now it is 5,200 rupees as of yesterday. which I saw. So if you see these stocks, they have multiplied significantly during lockdown. Cipla is again a pharmaceutical company. It's gone 100%. Auro Pharma has grown 100%. So companies, if you see during lockdown or not, market panic or not, negative sentiment or not, what has happened? The market fell, went up, but the companies which were dependent on the market flow, that is not in terms of stock market but in terms of revenue or sales, are those companies which grew significantly. So what we learn from this is, don't invest based on where the companies are growing. Invest constantly, keep changing your investment strategy based on what is the need and necessity of the market. So if I was in lockdown, what I would have done is, I immediately sold all my other stocks and invested in stocks probably which I feel could benefit out of the lockdown. Companies in technology, companies in FMCG, companies in pharmaceutical. So these are the future companies which are going to benefit. Now, companies which are going to issue vaccine for COVID. These are the companies which are going to have a future trend. Probably you have to funnel down a few companies who you can see can benefit out of the COVID situation, and prepare yourself probably to invest in these companies if they come into you. So you understand that investment is not about companies going up or down, or market sentiment or share value going up and down. It's about understanding the situation, understanding the industry, and understanding how the industry benefits from the situation. So in my opinion, there is always an opportunity in the industry. There is never a saying that market is bad, industry is bad. In the worst case scenarios also, you will have the best case opportunities as well. So it's all about how you understand the market, how you analyze the market, how you understand the risk, how you correlate the market with the stocks, and you see how they can make benefit out of it, inshallah. So this is just a graphical representation of how the companies have grown in the last 6 months. You can see the companies from 1,000 rupees. Reliance has come to 2,200. Britannia from 2,500 right now is trading at more than 4,000 rupees. Hero Corp, Motor Corp, that is again a bike manufacturing company, but probably Hero Motor Corp did not benefit that much in the lockdown, but they have other sources of revenue. That's the reason their company was growing. Infosys again multiplied significantly. Dr. Reddy's, as I told you, is 5,118 as of yesterday. Ultratech cement companies probably benefited after the lockdown more, but the stock price has grown now. During the lockdown, probably did not fluctuate that much. If you can see from March till August, they have been more or less in the 3,000 to 4,000 rupees range, and after that is where they felt that the graph was going up. So there are some exceptions also. Sometimes these companies like Ultratech and all grow because the market is growing, the Nifty is growing, or other companies are growing with the sentiment. They also end up growing. Auro Pharma, Cipla, HCL. These are not, by the way, just to give you a clarification, these are not recommendations. These are not something which I'm telling you to invest on. These are something which I'm giving you as examples, as comparative study, for you to understand the concept which I'm trying to preach and make you understand. Then we'll go to a brief understanding. We have probably 3 slides pending for today. So let's go to a brief understanding in a short span, because I have only 15 minutes left. So, or probably we can continue 1 or 2 slides tomorrow. So I will see how we can. Okay, well, let's go with positions in the stock market. Short position, as I told you, is basically selling position, where a lot of people end up doing short and long. This is an advanced technical concept. Probably for all the basic people, you do not necessarily have to give much of a thought to this. But for people who have been in the industry or in the stock market for quite some time, this will be useful for them. Because in this, what happens is people play with the short and long positions. So if you see, the more longer positions are there, the more positive sentiment. The more shorter positions, the more negative sentiment. Sometimes what happens is people just short a position and close at the end of the day. Now what happens is, during the whole day, if a person who is betting on the company saying it will go down, it will go down, it will go down, and you place 100 orders, but the company has not gone down. Company has gone on top only. So at the end of the day, he has to close that short position. When he's closing that short position, it is called short covering. So when the short positions are getting covered, naturally at the end of the day, the stock will start pumping up. If you have seen, 40% or 30% of the stocks at the end of the day suddenly rise 5-6%. It's because a lot of people are covering the short positions, which was a fake position with a fake sentiment. So this is something which comes into short selling or short positioning. Shorting basically is a strategy used with when an investor anticipates the price of a security will fall in the short term. Shorting again is not Sharia compliant. Why I'm telling you these things is these things will help you understand the game the company, the market plays, how they play with the sentiments of the investors. As investors, we are allowed to invest in the stock market in a cash basis. When you go into shorting, when you go into holding long positions, both of them come under future and options, which is not considered Sharia compliant, but it is a major portion of controlling the market. So you need to understand the concept, but you should also understand you should not be involved in the concept. The reason of explaining this to you is so that you can understand the concept better. Now, in common practice, short sellers borrow shares of stocks from an investment bank or other financial institution, paying a fee to borrow the shares while the short position is placed. This is exactly what I was telling you. So they borrow a share temporarily, hoping that it will fall. So they borrow the shares, hoping it will fall so that they can make the money and give the shares back. So if in case the shares have not fallen, when they're giving it back, when they have to close it at the end of the day, it is called short covering. The shares come back to the market and the shares value start increasing naturally. So it's an advanced concept probably for the people who have a basic idea about stock market or learning in basics. You don't have to consider this much right now. We will go in detail about this later on. Similarly, with long positions, long position means a person has a bullish attitude. A long position also means option contracts indicates a longer holding capacity, or you're holding an asset for a longer time. And without doubt, a long position is opposite of short position. In options, being long can refer either to outright ownership of an asset or being the holder of an option on the asset. Most of the time, what happens is people go in the future market as an option, that is borrowing a particular asset as an ownership. That is what future in options is all about. Now, when it comes to actual outright ownership, you might probably just buy the stock itself. So that itself is going long in the market. So when it comes to outright ownership, it is equity market. When it comes to being the holder of an option of an asset, it means you're talking about something in the future where you're borrowing something to make money. And so this again comes under non-Sharia compliance. Being long on a stock or bond investment is a measurement of time. So a lot of people end up being long on a stock or bond, hoping that there's a positive sentiment. This is an indicator in the market that there is a positive sentiment, the economy will grow, the market will grow. So probably if I've been a little fast and if you're not able to understand the slide, you can always approach me personally. I can give you a brief idea about this. There's no worries about that, inshallah. Then next will be the types of risk. It's just a basic outline about what different types of risk can be. Conservative, moderately aggressive, and very aggressive. So it's important we categorize different types of risk which are willing to take. I would suggest people start with conservative, then slowly build up their portfolio up till moderately aggressive, and only after heavy understanding and professionalism you can conduct it to or elevate it to aggressive. Very aggressive are people who are looking forward to make fast money very soon. Aggressive can happen occasionally, couple of times in a year, but moderately aggressive is something which will keep you ideal, it will keep you on the foot and help you understand the opportunities and use those opportunities in the right time possible. So in terms of high risk and low risk, what are the products which come under category? High risk are futures, options, and collectibles. Moderate risk, middle risk is real estate, equity mutual funds, large and small cap stocks, high income bonds, and debts. Base, that is low risk, government bonds, debts, money market, bank accounts, FDs, that is convertible debentures, CDs, notes, bills, cash, and cash equivalents. So just different sort of products segmented in the market in different formats. So this is just for you to understand what are the products in the market, what people generally do. So if, say, for example, the products down are getting affected, you know the products on top will also get affected. So this is something to see how they are dependent on each other. And probably if we go into explaining about this, it become too technical and too interrelated. So let's keep the initial day to basics, to fundamentals. For now, I think we have covered a lot of topics when it comes to in terms of what are the basics of a stock, how to analyze a stock, what is the industry have to see, what are the other things basically you have to consider. So alhamdulillah, we have considered the basics in the stock and the market understanding, and we hope that we have almost covered all the things necessarily required for a person to basically analyze a stock and choose a stock. Last but not the least, probably for today's session, what is the contango effect and a backwardation effect? It's a basic understanding. Contango effect basically means when you're investing in a particular market, the prices are getting higher based on the positive sentiment. Backwardation effect, the more negative people, the more selling, the stock gets frozen into a backwardation effect. So the more you can analyze contango and backwardation effect, you'll be able to enjoy the rally better. You will know exactly when the stock will move up, when the stock will move down. It's purely on the sentimental value. Impact cost represents the cost of executing a transaction in a given stock for a specified predefined order size at any given of time. So for example, now immediately if I'm putting 5 lakh shares to purchase, the moment someone sees that my 5 lakh shares are there in the pipeline to buy, other people will start buying. So in the process of me buying that 5 lakh shares, I will get 1 lakh shares at 100 rupees, 1 lakh shares at 102 rupees, 1 lakh shares at 103 rupees, 105 rupees, 1 lakh shares at 108 rupees, and 1 lakh shares at 110 rupees. That process of increasing the cost is the impact cost. So you can make an impact cost in a positive way and a negative way also. So for example, if you're buying a heavy volume of stock, if you want to create an impact, you have to be doing it in the right format. You should be able to do it more in the secret manner. You have an option in the stock market where people cannot know how much lots you're buying. So that way you can get exactly what you want, and your price will not increase from the exact target price you have. So today we have probably it's 10:20. So we have almost discussed about all the technical aspects, technical analysis, market analysis. Okay, technical analysis, market analysis, and a few basics about how to study a stock, how to go through the industry, what are the halal ways to understand the stock, what are the halal conditions of making a stock Sharia compliant or not. Alhamdulillah, we have almost tried to cover everything to the best of our capacity, because we don't want to overshower you or overload you with a lot of information as well. Probably we intend to make things more better and beneficial for you in our next significant 3 months, where you can constantly do your trading, and we will try to guide you by observing whatever you are doing. So what is the advantage of doing a trading, and how are we going to observe? Basically, the trading account will be in your hand whenever you're doing trading. Probably weekly or a couple of times in a week, we will see the reports of how you're trading, and we'll try to correct you if we feel something is going wrong, and we'll try to mentor you in terms of observation only. Probably initially we're not going to recommend, we're not initially also, but we don't intend to recommend stocks. We intend to teach you to become better individuals to invest, and inshallah we hope that that could become a trend, and we can hope that a lot more people will benefit out of that. Now before you go, probably I can give you one particular exercise, a basic exercise, something called paper trading, which is done basically for a lot of people in the market who are starting it new. So what I can do is I can ask you to choose a set of 5 or 10 companies today where you can do a paper trading. Say for example, Reliance, you write it down, price right now is this, I am buying Reliance right now at this time at this value. And tomorrow when you come to the class, if you see, you will have you will have an idea whether you have actually invested rightly in the stock or not. So paper trading is generally used instead of actually putting your money in the stock market and practicing. You can do paper trading for a couple of weeks. You can start doing actual buying and selling in paper. Be very true to yourself, be very disciplined, and when you do that, inshallah, you will have a fair amount of idea on how to penetrate the market. You'll have a little bit of confidence. You will have an idea that you're making right decisions or wrong decisions, and eventually that way you will get the flow of getting into the market softly without going big. And second thing, I will suggest people don't go aggressive in the market, don't go with big value, big money, go with very small money. Most important factor, invest only what you can afford to lose. This is very important. Please understand, I will repeat, invest what you can afford to lose. It's important you invest only the money which you can afford to lose or which you can sleep over. You don't have to be stressed about, oh, I spent so much money, my stock is in loss, my stock is in minus. Invest only what you can afford to lose, and inshallah you will be able to see the barakah of that positivity in it. Because the moment you're detached from your investment, the moment you're investing just for the opportunity without an emotional attachment, you will be able to make better decisions, you'll be able to make more successful decisions. And inshallah we hope that all what we have spoken today, what the information we have provided, will prove beneficial for all of you. We hope that we have tried to make the session as interesting and as simple as possible. And inshallah, may Allah Azza wa Jal accept it from all of us for using this opportunity to learn from each other, inshallah. So let's go with the final question answer session. and you can give me your feedback about the session, probably what you would like me to change, add for my tomorrow's class. I already have a PPT ready. I cannot do a significant change though, but yeah, I can try to see if I can add something here and there probably. So long is considered to be a long-term investment since daily trading is not halal. Long has its own part. See, when we say long investments, it doesn't necessarily mean you should go really long in terms of, because it's like if you're entering a stock at 100 rupees, what is the target price you're considering? 110 or 115? Whatever times it takes to achieve the target is a long-term investment. So probably you targeted it in 6 months, you will get 110 rupees or 120 rupees, but it came in 3 months. Yet again, even though it's a midterm investment, you consider going long into that product or going long in that particular equity company. So that's what I mean by long. When I say there's no particular time frame that this much month you have to be inside, it's more about how much you're able to understand the company and how much you're able to achieve the target which you have in terms of investments. So one Mr. Atikur Rahman, can you please explain the concept of margins again? Now, concept of margins, what I was mentioning is what happens is, say, for example, if I have 1 lakh rupee in my account, with that 1 lakh, I purchase stocks and I keep. Since I'm holding the stock, what happens is the broker with which I am dealing, they give me a margin of up to 7 times. So they say that you can buy up to 6 lakh rupees more, but you don't have the money. We will lend it to you. You buy stocks up to 6 lakh rupees. We'll give you a time of up to 7 days. Some brokers give 15 days, some brokers give 28 days, or some brokers give 3 days. We will give you 6 lakh rupees, use it for these 3 days, per day give us this much as interest, and for that 7 lakh rupees, whatever profit is yours. So what happens is most of the time people end up borrowing more to invest in the stock market. When they lose everything. So what happens is, obviously they'll not lose 6 lakh rupees. 6 lakh rupees is given on a marginal basis. So for example, if the loss is going below 1 lakh rupees, the whole transaction will get cancelled. So the moment 1 lakh rupee goes from your account, the transaction will be cancelled. So that's what is marginal investment, and that's what margins are all about when it comes to stock market. Paper trading, okay. How long is considered to be long-term investment since daily trade? Okay, then tomorrow paper trading session, choose 5 to 10 companies. Yes, so you have to choose 5 to 10 companies in terms of what companies you want to invest, where which industry you feel is ideal. Have a basic understanding within yourself, see how they are faring, and inshallah we can see how we can add more value to it. Okay, so Jazakallah khairan. I would like to thank all of you for giving me the time to listen to my session. It's probably 3 hours and it's a lot of time to listen. We see a lot of people from different parts of the world have been established and been part of the session. So inshallah, we hope that you benefit out of this, and may Allah Azza wa Jal accept it from all of us. Handing over to you, Aisha.
Thank you, Brother Jubran, for an informative session. We will be learning more on halal investing tomorrow. The participants' DMAT account creation process will be initiated soon. You can start trading once the account is created and will be mentored for 3 months by Brother Jubran. Opening a DMAT will help us to keep track of your trading activities. We will soon create a halal investment network where details about further seminars and other business conclaves will be shared. May Allah accept all our deeds. Wa akhir dawana alhamdulillahi rabbil alamin. Assalamu alaikum.